Can you all see me? Can you all hear me? Just let me know first and then we can start. Let me know. Can you all hear me? Can you all see me? Am I audible to all of you? Just let me know once. Mm, yes, sir. You seem to be audible one. Okay, okay, okay. So, hello everybody. Welcome to this English revision series for CA Final Direct Taxes and the National Taxation. I hope you all are doing really, really well. Sir, what we are doing today, why we have gathered. See, we are starting off with entire revision series for CA Final DT, that too in complete English. And this is first lecture to it. In this lecture, we aim to revise entire capital gain right away from scratch till the heights. Whatever we can understand, we will understand today only. Only your duty is only one thing. You just have to like the video, subscribe to the channel, and do comment down your experience. Everything, every doubt, whenever I ask anything, just comment down. So a very good evening to all of you present here. Let's start capital gain right away. Sir, where do we find this PDF? See, this is the PDF of my book. If you want to buy my book, it is available on website. If you don't want to buy whatever book you have, na, that will work. Absolutely, it's okay to have any other book. I don't force you to buy any book. Content remains the same. Sir, right away, starting from charging section. Sir, what does charging section implies? A charging section is nothing but 45(1), which says any gain arising from transfer of capital asset shall be taxable under the head capital gain in the year in which transfer took place. Now, what does that mean? Sir, we need to understand the definition of transfer. We need to understand definition of capital asset. We need to understand the definition of capital gain head, and at last, we need to understand what is meant by taxable in the year in which transfer took place. Everything has to be demystified one by one. First of all, what is capital asset? See, try reading it after me. Only three types of assets are asset capital assets. Three things are considered as capital asset. First of all, every asset is a capital asset. Every asset is a capital asset, but we have to exclude four things. First of all, stock in trade. Any stock that is held for business is to be excluded. It is not a capital asset. Second thing, any movable personal asset, anything that can move, anything that is personal, that has to be excluded from the definition of the capital asset. For example, the sweater I am wearing. Sir, any rural agriculture land, if I have any agriculture land in rural area, it is also not a capital asset. At last, any gold deposit bond, gold monetization certificate, these are also to be excluded from the definition of the capital asset. But remember, some things are not to be excluded, like any kind of drawing, painting, jewelry, sculptures, archaeological collection. These assets, despite of being movable and personal, they shall always be capital asset. This was the first thing, that is always a capital asset. Second thing, any securities held by FIIs. Any securities held by FIIs are always capital asset. In addition to that, any securities held by investment fund. Which investment fund? Alternate investment fund 1 and alternate investment fund 2. These are also considered as capital asset. Third thing, any ULIP is now a capital asset. We will study about this in much more depth. You need to understand what is a capital asset. First of all, every asset is a capital asset. Four exclusions are there. Then securities held by FII and investment fund. And third thing, any ULIP is a capital asset. These are capital assets. Now, some clarifications. If you have any TV, if you have any car, mobile phone, these are not capital assets. These are your personal assets. These are not your capital assets. But if you have any jewelry painting, despite of being personal, they would be capital assets always. If you have car used in business, it will always be capital asset because it is not personal. At last, sir, if you have any silver utensils, now these are considered to be personal ones, so these would not be capital assets. But if you have any gold utensils, why in the God's name will you have gold utensils at your home? Why in the God's name you will have gold utensils? Therefore, these are considered as capital assets. These are the basic definition of capital asset. Understand one thing. While understanding, while reading, while understanding and trying to recall capital gain, always you must have a single chart with you. I forgot to tell you, but this chart, you can take a screenshot of it. You must draw this chart and always be in line with the chart. Be in line with the chart so that you are aware of what you are reading. You are aware of what you are reading. Everything that is being done has to be marked in this chart so that whenever you are at a point, you are aware how much is left and how much has been passed. Look at this chart. You should take a screenshot, you should write it down in your book, and you should always mention things that you are studying along with the chart. Perfect, sir. Moving further, sir, what is meant by rural agriculture land in India? See, for understanding rural agriculture land, we need to understand what is the urban agriculture land. Now, what is urban agriculture land? For that matter, we have to see whatever the areas are there which has municipality or municipal corporation or cantonment board, it is always an urban area. If any of the area has municipality, if any of the area has municipal corporation or cantonment board, it is always an urban area irrespective of the population. But if the population of that area is up to 10,000 people, na, in that case, this area is the only urban area. What I'm saying is, if we have municipality, municipal corporation, cantonment board, it will be urban area. But if population is up to 10,000, then this area is the only urban area. But sir, if population is more than 10,000 up to 1 lakh rupees, then area beyond this, 2 kilometer area beyond this shall also be urban area. Apart from that, if population is more than 1 lakh up to 10 lakh, then area beyond 6 kilometers shall also be urban area. And if population exceeds 10 lakh people, in that case, distance to 8 kilometers shall be urban area. Beyond that, everything would be rural. Beyond that, everything would be rural. Did you understand? You have to find out municipality, municipal corporation, cantonment board. That will be urban area. If population is 10,000, then that area is the only urban area. Beyond that, everything rural. If population is more than 10,000 up to 1 lakh, then 2 kilometer beyond area is urban. If population is more than 1 lakh up to 10 lakh, then up to 6 kilometer area is urban. And if it is more than 10 lakh, then up to 8 kilometer area it is urban. Now we need to understand the definition of transfer. What does transfer mean? If you have any kind of capital asset that is being sold, if I sell any capital asset, if I exchange any capital asset, exchange shall also amount to transfer. If I have any asset which is being relinquished means it is gone. For example, if I have a house and I gift it to somebody, it is also transfer. Sir, any extinguishment of capital asset shall also amount to transfer. Extinguishment implies, for example, if I have shares in a company and that company is being liquidated, so it shall also amount to transfer. Compulsory acquisition of capital asset, for example, if I have a house and all of a sudden it has been acquired by the government, it shall also amount to transfer. Conversion of capital asset into stock in trade. For example, if I have a property, if I have a land, and all of a sudden I thought to use this land for the purpose of making houses and selling it to others. Now, when I change my purpose, when I change that capital asset into stock in trade, it shall amount to transfer. Next thing, very important point. If I hand over the possession of immovable property in part performance of the contract. For example, if I have a immovable property and I give this property to Manoj, in return, I have just received 1 lakh rupees. Remaining consideration is due. Remaining registry is due. Remaining agreement is due. Nothing has been finalized, but I have handed over the possession and received 1 lakh in return. That means the property has been transferred. Remember, handing over the possession of immovable property in part performance of contract shall amount to transfer. Sir, if we have any of the transaction which has effect of enjoying the immovable property, for example, what does this mean? See, for example, we have in society, in urban cooperative societies, now we do not actually own the properties. The properties are directly owned by the societies. We get a membership certificate, and based on that membership certificate, we get the right to enjoy that house. Now, if we want to sell that house, we do not actually sell the house, we sell the membership certificates. So that membership certificate give you the right to enjoy that house, and that is why the membership certificate transfer is also a transfer. And last thing, if you have any kind of zero coupon bonds which are being redeemed, redemption of zero coupon bond shall also amount to transfer. Based on the above definition, I can clearly say that destruction shall also amount to transfer. If any capital asset is destroyed, if partnership firm gives any asset to partner, it shall also amount to transfer. If we have any liquidation happening, that shall also amount to transfer. Any buyback, any slump sale, this everything shall amount to transfer. If any asset is being disposed of, for example, thrown, that shall also amount to transfer. If any asset is being parted off, that shall also amount to transfer. And at last, if any asset against which interest has been created, that shall also amount to transfer. For example, I have a house and I gave this house to Lalit for 200 years. Now, do I have the ownership of the house? Right answer is no, I do not have any ownership of the house now. Therefore, creation of interest shall also amount to transfer, whether done directly, whether done indirectly, whether done conditionally, whether done unconditionally, whether with agreement, whether without agreement, everything shall amount to transfer. Did you get this point or not? Are Baba, did you get this point? If yes, do comment down yes and we can continue. Now we have type of capital asset. Now basically we have two types of capital assets. First one is short-term capital asset. The other one is long-term capital asset. Now, whenever we have short-term capital asset, it will yield you short-term capital gain. And whenever we have long-term capital asset, it will yield you long-term capital gain. Now, how do we decide which is short-term capital asset and which is long-term capital asset? For that matter, we need to see the period of holding. If asset has been held for a more than specified period, then it shall be long term. If it is held for less than specified period, it shall be short term. Now, what is that period of holding? For four assets, we have 1 year of period of holding, and for other assets, we have 2 years of period of holding. Now, what it is, try understanding. We need to learn this. Huh? You should learn this. If you have any listed securities on recognized stock exchange, it can be shares, it can be debentures, it can be mutual funds, it can be anything which are listed on recognized stock exchange. Now, what is recognized stock exchange? National Stock Exchange or Bombay Stock Exchange. If you have any securities listed on these stock exchanges, if you have any equity oriented mutual funds, if you have any zero coupon bonds, or if you have any UTI units, these are to be held for more than 1 year. Not 1 year, more than 1 year. Kindly mind it. Kindly note it down somewhere. Not 1 year, more than 1 year, to make them long term. Else they will become short term. And any other assets if you have. For example, you have unlisted shares, you have immovable property. These are to be held for 2 years. Not 2 years, more than 2 years. These are to be held for more than 2 years to make them long term. Otherwise, they will become short term. For example, if you have gold, for example, you have building, for example, you have debt oriented mutual funds, for example, you have unlisted shares, you have any other asset, other assets has to be held for minimum 2 years. More than 2 years, they have to be held to make them long term. Did we complete the definitions? Now come on to chart. Now come on to chart. Why? Because we have to be very much aware of what we are doing. Okay. Coming on to chart, did we do the definitions? Perfect, sir. We are done with definitions. Capital asset transfer, period of holding, and rural agriculture land. We are done with the basic definitions. Moving on to computation part. And what is the computation part? Come on to the computation part. Just give me a second. Computation part. Now, what the computation part is, understand this. How do we compute capital gain? Sir, we have to take only few things. Whatever the full value of consideration is, take that. Minus transfer expenses, any brokerage paid, any commission paid has to be reduced, and this will give you net consideration. You have to reduce cost of acquisition, you have to reduce cost of improvement, and this will give you long-term or short-term capital gain depending upon period of holding. After that, you have to reduce the exemptions under 54, 54, 54F, whatever the exemptions you have, you just have to reduce this, and this will give you taxable capital gain, and based on this taxable capital gain, you will be charged tax. This is the basic thing. Now, in this entire process, how do we arrive at full value of consideration? How do we arrive at cost of acquisition? That is a point of concern. That is an important point worth discussing, and for that matter, come on to the topic of full value of consideration. Sir, at CFN level, you are teaching us how do we compute full value of consideration? Yes, it is a worth discussing point. Now, if I sell any asset, what is full value of consideration? Provision clearly states whatever the money that has been received or that have been receivable. If you have any asset being sold, whatever the money received or receivable, that shall constitute full value of consideration. But sir, in three cases, we have to take full value of consideration differently. Three cases are section 50C, 50C, and 50. Now, what is 50C? What it says? First of all, if you sell any immovable property, then you just don't have to take SDV full value of consideration. You have to consider stamp duty value as well. Full value of consideration and stamp duty value, and you have to check whether stamp duty value exceeds 110% of consideration. That means if a house is being sold at 10 lakh rupees and stamp duty value is 20 lakh rupees, that means you are defrauding by taking this full value of consideration. Now, provision says if stamp duty value is exceeding more than 110% of consideration, now in that case, stamp duty value shall be full value of consideration. Stamp duty value shall be full value of consideration. But sir, what if stamp duty value does not exceed 110% of consideration? Then in that case, your actual consideration paid will be full value of consideration. Are you getting? In case of immovable property, you have to consider the SDV. If SDV exceeds 110%, then SDV has to be taken as full value of consideration. Sir, sir, what if I am not satisfied with the SDV? What if SDV of my house is 50 lakh rupees and I am not satisfied with it? Can this happen? Can this happen that I am not satisfied with the SDV? Yes, it can definitely happen. Now, what do I do if I am not satisfied? I can go to valuation officer. Valuation officer will come to my house and he will find out the actual SDV. Now, what if valuation officer comes and he finds out a higher SDV? Original SDV was 50 lakh rupees and he increased the SDV to 1 crore rupees. What should I do? Provision says ignore. If he increases, ignore. If he reduces, take that. If you are not satisfied with SDV, now go to valuation officer. He might increase, he might decrease. If he increases, ignore. If he decreases, take the lower one. Then what would happen? Sir, which SDV are we going to take? SDV as on the date of registration or SDV on the date of agreement? Which SDV we are going to take? Important point. Sir, it is irrelevant. Relevant is whether you receive any money via account paycheck, demand draft, electronic clearing system or not. On the date of agreement, if you receive any money via account pay check, account pay demand draft, electronic clearing system, then SDV on the date of agreement would be taken. But if you did not receive any money, then registration would be taken. Clear to this point? Clear to this point, if you receive any money via account pay check, demand draft, electronic clearing system, as on date of agreement, then take the date of agreement. Even 1 rupee, even if you receive not, take that agreement date. But if you did not receive, take the registration date. Perfect, sir. Perfect, sir. Absolutely perfect, sir. Now, how do we compute the full value of consideration in case of unlisted shares? Now, if I have some unlisted shares, for example, Rahul Private Limited, and I sell them, how do we arrive at full value of consideration? We have to take the higher of. First one, we have to take FMV, or second thing, we have to take sales price. Whichever is higher, shall be computed as full value of consideration. How FMV is derived, sir? FMV is derived based on the report. It is derived on the valuation report of the chartered accountant or merchant banker. Remember, it is derived via the report of chartered accountant or merchant banker. Sir, provision says if any company is there, if any private company is there, whose board of director has been suspended by the central government, now, such company share if are sold, then 50 CA shall not apply. That means if I am selling the shares of Rahul Private Limited and Rahul Private Limited's board of director has been suspended, then considering full value of consideration shall be actual sales price, not the higher of. Perfect, sir. For example, if I am selling any asset, if I am selling any assets for which sales price is not determinable. For which sales price is not determinable. For example, what Sanket is saying, sir, you are not the best but bestest. Oh my god, Sanket, thank you so much for your kind words. Thank you so much. Now, for example, if I am selling a painting, now I am not even able to determine the value of it. If I have drawn a very good painting and I am not able to determine the value, provision says whatever the FMV as on the date of transfer, that shall be taken. FMV on the date of the transfer shall be taken. Did we understand how do we compute the full value of consideration? Did we understand how do we compute full value of consideration? Whatever the price has been received, that shall be taken. Receivable, that shall be taken. But in case of immovable property, we take it differently. In case of unlisted shares, we take it differently. And in case of any other assets whose FMV cannot be determined, shall be taken differently. Now, moving further to cost of acquisition. How do we determine the cost of acquisition of an asset? Basic fundamental is whatever the price paid to acquire the asset is the cost of acquisition. For example, if I have a land, whatever price I have paid for the land, that will be cost of acquisition. But in addition to that, provision says if any expenses have been incurred with respect to purchases, that shall also be added. For example, while purchasing any machinery, I paid the transportation charges, I paid the freight charges, I paid the installation charges. That shall also be added to cost of the machinery. That means any incidental expenses that have been incurred, that shall also be added to cost of the asset. Got this point? But remember, if you buy shares of a company now, never add STT. Never add STT. STT is never added to cost. Perfect, sir. Got that point. In addition to that, sometimes what happens is we have to pay some money to obtain the clear title of the asset. Now, what that clear title means, just understand. For example, some of the my father has acquired any property on loan. He could not pay the loan. I have to pay the loan amount. I have to pay the penal interest on the loan. Then whatever the extra money that I am paying now to obtain the clear title of the asset, that shall also become part of the cost. In addition to that, provision says if you buy any immovable property or if you buy any asset, for which you have taken deduction under section 24B. 24B, remember, house property interest expenditure, or chapter 6(8). What I'm saying is, actually try and understand. For example, if you buy any property on loan, now if you pay interest on this loan, interest is allowed as 24B under house property, plus interest is allowed under section 80EE. So if you have taken deduction under these sections, now provision says, then such interest shall not be allowed to you as cost of acquisition. What I'm saying is, if you have taken deduction of this interest under these two heads, now you will not be allowed as cost of acquisition. Am I very clear? Am I very clear? If it is clear now, and you have come to this far and you have not subscribed to this channel, I will start crying. I will start crying. Sir, deduct 50 rupees for overacting. Deduct 50 rupees for overacting. No, no, no. So these were the basic provisions. Do like the channel, subscribe to the channel, hype the video so that it is reachable to most of the students. Take care. Now, this was the basic case. How do we arrive at cost of acquisition? But cost of acquisition is considered differently in different cases. There are some special cases as well. For example, there is my brother. Okay, brother acquired house for 10 lakh rupees and he gifted this house to me. Now, how would we arrive at cost of acquisition? Provision says, in case of exempt transfer, take the cost of acquisition of the previous owner. Take the cost of acquisition of the previous owner. What does it says? If you have acquired any property on account of exempt transfer, take the cost of acquisition of the previous owner. Now, another important point. So sometimes what happens is, if you have acquired any very old asset, is it possible did you acquire very old asset? Is it possible? Yes, sir, it is possible. It is possible that I have acquired a very old asset. So asset acquired before 1st April 2001, then you have to take the FMV as on the 1st April 2001 or the purchase price, whichever is higher. If you have very old asset, before 1st April 2001 you have acquired that asset, now you have to take the FMV or the purchase price, whichever is higher. FMV or purchase price, whichever is higher. Remember, this is a very important clause applicable to all the assets. Whatever assets you have, if you have acquired before 1st April 2001, you have to take FMV or cost, whichever is higher. Now, sir, if I have any intangible assets, can I have intangible assets? Yes, sir, I can have. Sir, intangible assets can be goodwill, trademark, brand name. It can be patent, copyright. It can be right to carry on any business. It can be tenancy rights, loom hours, route permits, or any other intangible asset. How do we determine the cost of acquisition of an intangible asset? For that matter, provision says, find out whether such intangible asset is self-generated or not. If I have myself created that patent, if I have myself created that copyright, if I have myself created that goodwill, it will always be nil. Always nil. But if I have purchased that intangible asset, provision says, then price paid to acquire that asset shall be cost of acquisition. In addition to that, remember, I have just 2 minutes ago I said that for every asset you get the FMV benefit as on 1st April 2001. But for intangible assets, you do not get this benefit. Did I make it very clear? For intangible assets, you do not get any FMV benefit. And it is very logical. How will you be able to determine the FMV of an intangible asset? We are not able to determine the FMV of normal assets only. How will we be able to determine the FMV of intangible assets as on 1st April 2001? Therefore, FMV benefit for intangible assets are not available. In addition to that, if intangible assets form part of a block, then in that case, actual asset acquired minus depreciation shall be considered as the cost of asset. Did we understand this thing? Yes, sir, we understand this thing. Then we have bonus shares. I have shares of a company and I got another shares for free of cost. Now, what will be cost of acquisition? See, by default, bonus cost of acquisition is nil. If nothing has been mentioned, cost of acquisition for bonus shares is nil. But sir, if bonus have been allotted before 1st April 2001, allotted before 2001, then FMV as on 1st April 2001 is allowed to us. Sir, if it has been allotted after 1st April 2001, normally nil, but if shares of such company are listed, that is fall under 112A, then we get benefit as on 31st Jan 2018's FMV. What did I say? By default nil, but if acquired before 2001, then FMV as on 1st April 2001. If acquired later on, if they are listed, then 31st Jan 2018 FMV is given to us. Now, right shares, how do we arrive the cost of acquisition of a right share? Understand this thing. Now, what does this mean? Understand. For example, shares of Reliance are being traded at rupees 1500. I got an opportunity to buy this share for 1200 rupees and I used this opportunity and bought at 1200. What will be my cost of acquisition, sir? Simply 1200 now. If you buy any shares on account of right shares, whatever price you pay to company, that will be your cost of acquisition now. This is only, it says cost of acquisition will be amount paid to the company. You remember. Can I renounce this right? Can I sell this right to buy at rupees 100? For example, at rupees 100, I sold this right to Sanket. For example, I sold this right to Sanket. Provision says whatever renouncement money you get, sir, that is short term capital gain. And the best part, if somebody is listening to this, do give a timestamp to this. So this short term capital gain is taxed at the rate of slab. Always understand, always remember, if you have any renouncement right, if you have any gain on account of renouncement of right, that will be short term capital gain, and that will always be short term capital gain being taxed at slab only. Perfect, sir. We got this point. Sir, what will happen? What will be the purchase price for Sanket? What will be the purchase price for Sanket? See, Sanket acquired shares at 1200 rupees only, plus he paid 1100 rupees to acquire that right. So Sanket's share price would be 1300, and the same has been given here. For the purchaser of the right, cost of acquisition will be amount paid to company plus amount paid for that right. Now, what is the cost of acquisition for sweat equity shares? Important point. What is the cost of acquisition for sweat equity shares? Understand. Very important point, sir. Very important point. If you are not paying attention, please pay attention. Otherwise, I will cry. Sir, for example, I work at Reliance and Reliance shares are being traded at 1500 rupees. And I got an ESOP to acquire these Reliance shares at 500 rupees. Or I should say, to make it simpler, 600 rupees. I have got a right to acquire these Reliance shares at 600 rupees. Now, what will be my cost of acquisition? If I sell this Reliance shares for say 2500, what will be my cost of acquisition? 1500 or 600? Right answer is it is not 600, it is 1500. Why 1500? Simple reason being, sir, this difference of 900 is already taxable under salary. Therefore, whatever the FMV as on the date of exercising the option is, that will be considered as the cost of acquisition. So in ESOP, price paid to company is not the cost of acquisition. Price paid to company is not the cost of acquisition. Cost of acquisition would be FMV on which the option is exercised. Sir, if you have any depreciable assets, whatever the cost of acquisition minus the depreciation, that will give the, which means WDV only. Sir, if you have any demerger, now what happens in case of demerger? Understand what happens in case of demerger. For example, we have a Reliance which has net assets of 1000 crore, and out of this, and share price of 1500 each. Okay. Now out of this Reliance, Geo got demerged, and demerged Geo took 100 crore of assets. Demerged Geo Financial Services took 100 crore of assets. So can I say 10% of assets are being taken over by the Geo? Right answer is yes, 10% of assets are taken by Geo. Therefore, 10% share price would also go to Geo. Therefore, share price of the resulting company would be 150. For example, if Geo has issued 1:1 ratio, Reliance, every shareholder of Reliance got one share of Geo, then theoretical share price of Geo would be 150. Correct? Got it? Reliance shares would break by 150, that means 1350 would be shares of the Reliance. Simple provision it is in case of demerger. Sir, sometimes what happens, share ratio is not 1:1, ratio is 1:3. That means for every one share of Reliance, shareholder got three shares of Geo. In that case, this 150 would be divided by 3. That means share price of Geo share would be 50 rupees in this case. If you want to listen to this point again, just rewind it and listen to this point again. This is important point. This is important point. Many people do not understand the value of this point. Okay. Now we have completed the basics as well. Now come on to again come on to the chart. Where do we stand right now? We understood the basics. We understood the computation part. We understood how basic computation is done. We understood the format. We understood how sales consideration is being derived at. Now we understood the cost of acquisition as well. Now we have to move to advanced cases. Advanced cases. Now, what these advanced cases are all about, come on to first advanced case, that is taxation of ULIP. Take a long breath, take a very long breath, and come on to ULIP taxation. Basically, not just ULIP, but we have ULIP and LIP as well. Okay, 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 perfect, perfect. We are back now. Now, what did we discuss? What did we discuss? Understand this thing, huh? Understand this thing. This breakage was internet off the internet na can be pardoned by you all. Now, if annual premium exceeds 10%, 15%, 20% criteria, it will always be taxed under capital gain only. Earlier it was IFOS, but it is now capital gain. Now, what if the annual premium is within 10%, 15%, 20% criteria? What will happen if annual premium is up to 10%, 15%? See, earlier it was exempt. Up to 1st Feb 2021, whatever the ULIP that were issued, that were exempt. Those were absolutely exempt. But with effect from 1st Feb 2021, with effect from 1st Feb 2021, understand this thing. Huh? Understand this thing very carefully. See, if aggregate premium is up to 2.5 lakh rupees on individual or aggregate, it shall be exempt. But if aggregate premium exceeds 2.5 lakh rupees in a financial year, it will be taxed under that capital gain. It will be taxed under that capital gain, remember. So, what did I say? If aggregate premium exceeds 10%, capital gain. If it is within 10% limit, exceeding 2.5 lakh, again capital gain. And which capital gains are 112A? It will go to 112A. Got this point, sir? Carefully got this point. Can we take one example to that? Can we take one example? Please participate in this example. What I am saying is 1st Feb 2021. The sum a ULIP bought which for on which sum assured was 12 lakh rupees and annual premium was 1.2 lakh. Am I fulfilling 10% criteria? Yes, sir. 10% criteria is fulfilled. Whether annual premium is up to 2.5 lakh rupees? Yes, annual premium is up to 2.5 lakh rupees. Will this ULIP be exempt? Right answer is ideally this should be exempt. On the very next month, I bought another ULIP on which sum assured was 13 lakh rupees. Now, on this annual premium is 1.3 lakh rupees. Am I fulfilling again the 10% criteria? Yes, I am again fulfilling the 10% criteria. Again, whether annual premium is up to 2.5 lakh rupees? Yes, annual premium is up to 2.5 lakh rupees. Annual premium is up to 2.5 lakh rupees. Combining both of two, whether annual premium is up to 2.5 lakh? Yes, annual premium is up to 2.5 lakh. That means whether the third ULIP would be exempt? Yes, third ULIP would also be exempt. Coming on to next ULIP. Again, I bought another ULIP on 1st April 2021 for 24 lakh as sum assured. Annual premium on this is 2.4 lakh rupees. Listen to this point. Annual premium is 2.4 lakh. Am I fulfilling 10% criteria? Yes. Whether annual premium is 2.5 lakh? Yes, up to 2.5 lakh. But individually it is 2.5 lakh only now. But if we consider ULIP 2, ULIP 3 and ULIP 4, aggregate premium would cross 2.5 lakh limit. Aggregate premium on all those ULIPs would cross 2.5 lakh limit. So here we have a choice. Either to use this ULIP 2 and ULIP 3 together as exempt and tax this, or either we can take this as exempt and tax this. We have a choice. We have a choice. We have to make a choice because only ULIPs on which 2 lakh on which premium is up to 2.5 lakh that will only be exempt. We have a choice. We have to utilize the best. So in that case, provision says if you exempt ULIP 2 and 3, then 7 lakh would be exempt. If you exempt ULIP 4, then 5.8 lakh would be exempt. Of course, you would go with ULIP 2 and 3, and that is how you have to solve an exam if it is being asked. If multiple ULIPs have been given, you have to decide which ULIP to choose. You have to choose the ULIPs on which maximum exemption you are going to get. Are we clear with ULIP taxation? Are we clear with ULIP taxation, sir? Very much clear with the ULIP taxation. Now come on to LIP. How LIP or life insurance policy is being taxed. Understand. If you buy any of the life insurance policy on which annual premium is more than 10%, 15%, 20%, then it shall definitely go to IFOS. Earlier also it was IFOS, today also it is IFOS. But sir, if annual premium is up to 10%, 15%, 20%, then what would happen? Provision says, check out whether that LIP, life insurance policy, is being issued before 1st April 2023 or not. If it has been issued before, then it shall be exempt. But if it is issued after 1st April 2023, then you have to check if aggregate premium is up to 5 lakh rupees now, then only it will be exempt. One policy, two policy, three policy, all the policies bought together, if aggregate premiums up to 5 lakh rupees, excluding GST amount, then it shall be exempt. But whatever the policies that go beyond 5 lakh rupees, that shall become taxable and taxable under IFOS. Remember, ULIP exceeding 10%, a capital gain. Below 10%, more than 2.5 lakh, capital gain. LIP, exceeding 10% IFOS, exceeding 5 lakh again IFOS. Whatever the ULIP, whatever the LIPs we have, sir, if it has been received on account of death of a person, it is always exempt. Whenever we receive any LIP on account of death of a person, it is always exempt. There is an amendment if we have any of the LIP, if we have any of the life insurance policy that have been issued by a unit located in IFSC, then it shall be exempt. Any life insurance policy issued by the unit located in IFSC, that shall be exempt. Sir, we got this point. This is all about the ULIP taxation. If it is clear, do comment down clear. If it is really clear, do like the video. Do like the video and like in odd numbers. Like once, like three times, like five times, like seven times. Do not like in even numbers. Always like in odd numbers. So, okay, got it, sir. Come on to second special case, that is slump sale. Second very special case, not just a special but very special case, the slump sale. Favorite of ICI. Now, what is slump sale? Sir, we do not sell the entire business, but we sell the unit of a business. We sell undertaking of a business at a lump sum consideration, where we do not separate the individual assets, rather we entirely sell the unit without assigning individual assets to a system. For example, if we have two units, for example, Rahul has two units. One is textile unit, one is chemical unit, and all together I am selling this chemical unit for 5 crore rupees. This would mean slump sale. Now, how capital gain is calculated in case of slump sale? Understand. Take full value of consideration minus cost of acquisition. This will give you slump sale. Wow. Full value of consideration minus transfer expenses. With this will give you net consideration. Minus cost of acquisition. This will give you capital gain. It can be the short term capital gain. It can be long term capital gain. Wow, sir. Wow. Listen, a very important point. Somebody who is listening, please, at this point, do give a timestamp. Sir, for slum sale, period of holding is not 2 years but 3 years. If a unit has been held for more than 3 years, now then only that will become long term. Otherwise, it will become short term. Remember, for slum sale, we do not have any change in period of holding. It is always 3 years. It has been 3 years. It is 3 years, and then it will be 3 years unless it will be changed. Got it, sir? We understand that point. Now, important is how do we arrive the full value of consideration and net worth, yeah, cost of acquisition. For full value of consideration, we have to take two things: FMV1, FMV2, higher of 2, and for cost of acquisition, we would take net worth. It is very easy. It is very easy. What I am saying is just try to say after me. Whatever I am saying, just try to say after me. Sir, FMV1 means whatever the assets that have been gone, take FMV of that. FMV2 implies FMV of all the assets received. FMV of the assets gone are FMV1. FMV of the assets received is the FMV2. For example, if I have sold a cow, then whatever the FMV of cow is FMV1. In return, I have got gold. Then whatever the FMV of gold is, that will be FMV2. Got it? And what is net worth? Net worth is nothing but we will understand. Now, how do we arrive FMV1 and 2? Understand. FMV1 means that the FMV of assets gone, FMV of the assets gone. If any immole property is gone, then take the SDV of that immole property. If you have any shares, then take the fair market value of the shares. If you had any jewelry, artistic films, for example, if you have any paintings that have been gone with the unit, take the open market value of that. And whatever the other assets have been gone, for example, debtors would also be gone, inventory would also be gone, bank balance would also be gone. Provision says take the book value of all those assets. This will give you FF1. Reduce the liabilities at book value. Remember, share capital, reserves and surplus, dividend, provision for tax, uncertain liabilities, contingent liabilities. These are not the liabilities. These are not even considered liabilities. In addition, if you have any TDS, TCS, advance tax, and deferred revenue, just net them off and find out the actual tax payable or refundable. This will give you FMV1. Now you have to identify FMV2 as well. Now, what is FMV2? Whatever assets have been received. In case you receive cash, take the cash value. If you are receiving any shares, take the shares FMV. If you receive any immole property, take the SDV of that immole property. If you receive any jewelry in return, if you receive any, for example, painting in return, then take the open market value of that, and this will give you FMV2. So FMV1 assets given, FMV1 assets given FMV, FMV2 assets received FMV. Then we have, net worth. How do we arrive at net worth? Understand. Sir, whatever, take the balance sheet of the assets, take the balance sheet of the undertaking being transferred. Whatever the depreciable assets we have, take the WDV as per Income Tax Act. WDV as per Income Tax Act. If any revaluation has been done in the assets, now that has to be taken off. Revaluation is to be ignored, that has to be removed. Impact of revaluation has to be removed. If you have any 3580 assets, take nil. If you have any self-generated assets like goodwill, take nil. Any other assets like data, like inventory, like any other assets has to be taken at book value. Investments to be taken at book value. Reduce the liabilities and this will give you the net worth. If net worth is negative, assume that net worth is zero. Reducing that would give you capital gain. Now, when do we calculate these figures? These figures have been calculated on date of slump sale. Got it, sir? Whenever slump sale happens now, before 44 AB tax audit, you have to get a CA certificate certifying the net worth of the undertaking. Taking the you have to get the CA certificate to get the net worth of the undertaking. Now there are two tools that have been given to save the slump sale taxes. To save the taxes on slump sale, these are absolutely ridiculous. Why ridiculous? Understand. For example, if Rahul has two units, first one is chemical and the other one is textile. Now, if I am selling this textile unit, I can save my taxes by doing two things. What two things? First of all, if you are selling it to somebody now, demerge it. Demerge this entity because demerger is an exempt transfer, so this will save your taxes. Wow! Arey yaar, how can demerger save the taxes? See, ultimately, I have to get rid of this unit now. I have to get rid of this unit. How would it save taxes? I don't know. But simply it says demerger would save the taxes. Second thing, what I can do, for example, this is Rahul. And Rahul has two units. One is chemical and one is the textile unit. And for example, we have Ravi. Okay. If I want to sell this unit to Ravi, what I can do now? I can acquire the 100% shares of Ravi and then sell it to this unit. They sell it to Ravi. What would happen? Now, Ravi would be 100% subsidiary of mine. If Ravi is 100% subsidiary of mine, in that case, what would happen? Any transfer is exempt transfer, so no taxes. Wow, what a way of saving the taxes. Completely useless, completely useless. But given, so we have to, as it is, write an exam. If it is being asked how do we save the taxes in case of slump sale, we have to write as it is. Understand this. Okay. Now, very important section. Take a long breath and then we start. What this section is all about. Understand this point. If any partner transfers any asset to partnership firm, partner transfers to firm, or firm transfers to partner, we need to understand the taxation of both the cases. First of all, if any partner has any land, for example, any asset partner has and he transfers the such asset to firm. What would happen in this case? Provision simply says, partner would be charged to capital gain. Partner will be charged to capital gain. How much capital gain? Sir, full value of consideration would be amount recorded in the books of the firm. Whatever the amount that has been recorded by the firm, that shall be considered as full value of consideration. Minus cost of acquisition. This will give the capital gain in the hands of the partner. Very simple point. Really, very simple things cannot be simpler than this. If partner gives any asset to partnership firm, he will be charged to capital gain. Perfect, sir. Perfect, sir. Sir, what if firm provides assets to the partner? Here we have two special cases. First of all is dissolution of firm. At the time of dissolution, assets are being transferred, or at the time of reconstitution, assets are being transferred. Now, at the time of dissolution, one section would come into picture, that is 9B. At the time of reconstitution, two sections would come into picture, that is 9B plus 45(4). At the time of dissolution, 9B would come into picture. At the time of reconstitution, two sections, 9B and 45(4) would come into picture. Now, what these two sections says, first of all, understand the tone of the section. Understand the tone of the section. First of all, what 9B says, if a partner goes at the time of dissolution or at the time of reconstitution, if you give any asset to a partner, assume you have not given it to partner, you have given it to third person. You have given it to a third party, and whatever capital gain would be arising, whatever PGPP would be arising, same PGPP has to be paid by the firm. 9B says the simple thing. Assume you have not given the asset to the partner. If you would have sold this asset to an outsider, then whatever the capital gain, whatever the PGPP that would arise, just pay that. Whatever the capital gain, whatever PGPP would arise now, that has to be paid. That is set by 9B. This is what is written. Reconstitution, admission, anything, if any asset or any stock is given by the partnership firm to the partner at the time of reconstitution or dissolution, then such distribution shall be deemed to be transfer and capital gain would arise. PGBP shall arise. Simple point. Assume it is not given to partner, assume it is given to somebody else, and whatever capital gain, whatever PGBP would be arising, if it is sold to an outsider, then that has to be paid. Perfect, sir, perfect. What 45.4 says, 45.4 says something differently. Understand the tone of the section. If you give any money to a partner, if you give any asset to a partner at the time of reconstitution, his capital was due 35 lakh. Understand, if capital is due 35 lakh, and in return you are giving him assets of 60 lakh rupees, this might happen. You might give something more. The capital was due 35 lakh and you are giving him 60 lakh rupees. Why are you giving more than his capital? If you give any asset to a partner more than his capital, that means partner has given you something extra. For that matter, you will be charged capital gain. Again, listen to this point. Again, listen to this point. If partner at the time of reconstitution is being given an asset beyond his capital account, in that case whatever the extra you have given is nothing but a benefit that have been received from the partner, and that will be charged to 45.4. I think in revision we can discuss this much only. Understand how the taxation works out in this case. We have an example is to be understood beautifully, sir. For example, if we have a firm X and company, Exent company has four partners. Whatever I'm saying is written here. Whatever I'm saying is written here. If you have any other book now, that book will have the same example, because this is a classic example of 45.4. It has four partners which have Prem, X, Y, and Z. On 1st April 2025, Prem retired. He was given a land whose worth is 45 lakh rupees. He was given cash of 15 lakh rupees. Perfect. And his capital was due before reconstitution was 32 lakh rupees. At the time of retirement, firm has multiple other assets. For example, it had land at Pune which was acquired at 15 lakh rupees. It is worth 50 lakh rupees. That means revaluation in this land is 35 lakh rupees. Oh. Nagpur land has been given, so we don't have to take the revaluation figure. Mumbai land, which was 88 lakh rupees, is now revalued at 250. That means revaluation took place at 162 lakh. Goodwill, which was 0, is now revalued at 70. That means, can I say goodwill is valued at 7? Goodwill revaluation is 70 lakh rupees. Perfect, sir. Now, on 1st April 2025, Exent Company gave the land of Nagpur and 15 lakh to Mr. Prem to settle his capital. Now, two sections come into picture. First of all, 9B and 45.4. What 9B says, again recall the tone. Assume this land was sold to an outsider, then whatever capital gain would arise has to be paid by the firm. Assume if this Nagpur land was sold to an outsider, then 45 lakh would have been full value of consideration. 25.4 lakh, whatever the cost of acquisition was, would be reduced. Therefore, 19.6 lakh would be long-term capital gain in the hands of the firm, and on that 12.5% taxes would be paid by the firm. 2,54,800 would be the actual taxes amount in the hands of the firm. Actual taxes amount in the hands of the firm. Very logical point. Very logical point. If this is sold to an outsider, whatever amount we receive has to be subject to taxes. Similarly, if you are giving it to partner also, then it should be taxed as well. No? So 9B says the same thing. This is to be paid under 9B. 45.4 says, see, if this land would have been sold to an outsider, then how much partner's capital would have been? See, 32 lakh was the original capital. 19.6 lakh was the profit amount that each partner would get, or total partners would get on account of sale. In addition to that, 2,54,800 would be the taxes amount. That means net addition to all the partners would be 17,05,200 divided by 4. That means 4,26,300 is the each partner's profit at the time of sale. If this land would have been sold to an outsider, each partner would benefited by 4,26,300. That means each partner's capital would be 36,26,300. Take a deep breath. If this land would have been sold to an outsider, every partner's capital would have been 36,26,300. Now, why this partner is being given 60 lakh rupees, 45 lakh worth of land, 15 lakh worth of assets? Why this partner is being given this much? Why this partner is being given this much of assets? Provision asks the same thing, and therefore this difference will be taxed to 45.4 capital gain. This difference would be taxed under 45.4 as capital gain. Difference would be taxed in that manner. Issue here is we are giving the same asset only once. Only once we are transferring the asset, but capital gain is being charged twice. We are handing over the asset only once, but capital gain is being charged twice. So what happens? Whatever the amount of capital gain under 45(4) is, that is being reapportioned to the other assets that are being revalued. For example, Pune land is being revalued at 35 lakh. Mumbai land is being revalued at 162 and goodwill is being revalued at 70. So in this 35 is to 162 is to 1 is to 70 ratio, the other assets will get the revaluation gain. This is the same thing that we have done. Whatever the profit is, 2373,700 divided by 30 into 35 into 162 into 70 divided by the total, and this is the amount of attribution these assets would have. And whenever we will sell these assets, this capital gain would be reduced. Again, here this point at least 2 to 3 times, you will get a fair idea as to what the section says. Now, we have another important point. For example, if AOP distributes its assets to the members at the time of reconstitution, at the time of dissolution, same provisions would apply mutatis mutandis. That means as it is. If AOP transfers the asset, it shall apply as it is. It shall apply as it is. Got it, sir. Got it, sir. Absolutely got it. Come on to next special case, that is liquidation of a company. Very beautiful yet very important section. Liquidation of a company. Take a deep breath. At the time of liquidation of a company, two sections are being invoked simultaneously. Not one, but two sections are being invoked. First section is being invoked is section 222C. What this says? Section 222 says clearly says if you distribute any of the money, any of the asset at the time of liquidation of a company, then whatever the amount of accumulated profits are, up to that amount distribution would be deemed dividend. We are already aware of this point under IFRS. If you have any of the asset, if you have any of the money that's being distributed at the time of liquidation, then it is considered as deemed dividend to the extent of profits. Second thing, since liquidation, at the time of liquidation, shareholders' right in the company are being sold off, shareholders' right are being relinquished. In that case, capital gain would also rise. Therefore, in the hands of company, no taxation would take place. No taxation at all would take place in the hands of the company, but in the hands of the shareholders, multiple things would undergo changes. Multiple things. And what are those multiple things? Sir, he would be charged to 222C, he would be charged to capital gain, and how things go. I am taking an example to make you understand. For example, this is Rahul Private Limited, and Rahul Private Limited has only one shareholder, that is Rahul, whose share capital is 1 crore. His reserves surplus are 9 crore. He has a land of 10 crore, whose FMV is 100 crore. Now, this company went under liquidation, and this land was given to Rahul. This land was given to Rahul. Provision says since 9 crore is the accumulated balance of reserves and surplus, out of this 100 crore distribution, 9 crore would be deemed a dividend in the hands of the Rahul. 9 crore would be deemed a dividend. What will happen to the balance? That will be capital gain. Now, how capital gain would be computed? Take full value of consideration being the amount distributed, minus what would be the cost of acquisition of the Rahul? Of course, the amount of share capital 1 crore. 99 crore, and reduce the amount on which deemed dividend has been charged. That means entire capital gain would be 90 crore only. Understand, whatever the amount that is being charged to deemed dividend, that will be reduced while computing the capital gain. Really got this point? Do like the video once. Do like the video once. Do subscribe to the channel and share it with one of your friend. Got it, sir? At the time of liquidation, two things take place simultaneously. First thing, deemed dividend, and whatever the amount on which deemed dividend has been charged, such amount shall be reduced while computing the capital gain. Got it, sir. Got it, sir. Got it. Section 50 AA, very beautiful section, and yet not asked yet. Yet it has not been asked. It is really, really important from examination point of view. I personally think it is very important. Sir, section 50 AA talks about three securities, which might be long-term securities, which might be short-term securities. We don't care. They might be long-term capital assets. They might be short-term capital assets. We really don't care. What we really care is whenever you sell them, whenever you transfer them, you will be charged to short-term capital gain. What did I say? Securities might be long-term capital asset, might be short-term capital asset, but capital gain will always be short-term. Got it, sir? What are those three securities? First of all is market linked debentures. Market linked debentures. For example, this is Rahul and other parties Ravi. I said, Ravi, are you going to give you money? Ravi said, why not? Why not? Take whatever money you want. I said, sir, I said, Ravi, what do you want in return? Ravi says, interest. I said to Ravi, how much? Ravi says, sir, I cannot tell something adventurous. Adventurous. I asked Ravi, what is adventure? Ravi says, sir, whatever you want, but it cannot be plain vanilla. It has to be some adventure involved, some thrill involved in this interest. I said, okay, Ravi, I will pay you interest equal to 1.2 times of gain that Nifty will be making in next year. Whatever the amount Nifty gains, I will pay you 1.2 times. If Nifty grew by 10%, I'll pay you 12%. If Nifty grew by 50%, I'll give you 60%. If Nifty grew by 100%, I'll give you 120%. Any securities on which interest is dependent on an underlying asset. It can be any market, it can be any security, it can be any of the thing. It can be any index. If interest is dependent on an underlying asset, now then mean it is market linked debentures. Second thing, which second security is covered? Second is specified mutual funds. Now, what are these specified mutual funds? So, any mutual funds whose out of the total proceeds, for example, any mutual fund is there. For example, Rahul Private Limited, Rahul Mutual Fund. Out of the total proceeds, less than 35% have been invested in the domestic shares. 35 less than 35% have been invested in the equity shares of domestic company, equity shares of a domestic company. That means these are specified mutual fund. Remember, any mutual fund that is issued on or after 1st Feb 2023 is only specified. Mutual fund issued before 1st April 2023 will not be specified. Only after 1st April 2023 will be specified. Sir, perfect. Perfect, perfect, perfect. Third security is that third security that is mentioned under 50AA is unlisted bonds and debentures. If you have any of the bonds or debentures which are not listed on recognized stock exchange, that are being transferred, that are being redeemed, will fall under 50AA. So three securities I did mention. First of all, unlisted bonds and debentures. Second one, market linked debentures. Third thing, specified mutual fund. If you transfer any of them, whatever the capital gain will arise will always be short term, will always be short term. Now we have transfer of demat securities. Now what does this simply mean? Understand this point very carefully. What is transfer of demat securities? See what happens if you sell any of the physical share. Then you are actually aware of the purchase price. At what price it is being sold, you are aware. At what is the cost of that share, you are also aware. That is given in the share certificate. And what if you sell securities which are in the demat form? For example, you have 5 shares of Reliance. First share were acquired on first April. It was 1500 cost. Second share was acquired on 1st May, it was 1600 cost. Third share was acquired on 1/6, it was 1700 cost. Now, how do you arrive? How do you understand what is the actual cost of the share that is being sold? Provision says use the FIFO method. Whenever you have any demat securities, now always use FIFO method. Whatever the share that was entered into demat account first shall be considered as first being sold. So it might happen that you are being given one share of being dematted. That means you had old physical share and it got demat on 1st July. Its cost of acquisition is just 10 rupees. Even though it was originally acquired way back, but that shall be considered as fourth in number while being sold. Understand this point very carefully. Even though the share was acquired way back this, then this, but since it got dematted later on, it got dematerialized later on, it shall be fourth into the list while selling the shares. First of all would be 1st April share only. Got this point? Yes, sir. Last special case that is advance money forfeiture. Now, what is this all about? See, if you sell any house at the time of sale, if somebody gives you any advance money and you forfeit that money, then what happens? That forfeiture is being taxed in two manner. If that forfeiture has happens after 1st April 2014, that means after Modi government coming into picture. If advance money is being forfeited after Modi government into coming into picture, that means in that case now it will be taxed under IFOS, flat IFOS, clear cut IFOS. But sir, if any advance money is being forfeited before Modi government coming into power, that means before in that Congress power, I mean, it is being forfeited. Provision says it will go to cost of asset. It will be reduced from cost of asset. How it is being reduced? Understand. For example, cost of a house is 10 lakh. It is being sold for 50 lakh rupees. See, earlier you were willing to sell this house, but advance money was received and you forfeited that 50,000 was forfeited. Now, whenever you will sell that house now and you take cost of acquisition of 10 lakh, you have to reduce this advance money forfeiture. That means your cost of acquisition would be only 9.5 lakh. Got this point? Did you get this point, sir? We got this point. We got this point. Now, listen to this point very carefully. Very, very, very carefully. What if Rahul has a house acquired for 10 lakh rupees? I give this house to my sister. Gifted this house to my sister. I forfeited advance money of 50,000 rupees and I gifted this house to my sister. And later on, my sister sold it for 50 lakh rupees. Now, what would be the cost of acquisition for my sister? Provision says if my sister received this house on account of exempt transfer, cost of acquisition of the previous owner shall be taken. Previous owner is 10 lakh rupees. Now, when my sister is making a sale, whether this 50 lakh would be reduced? Right answer is no, it would not be reduced. Why? Because provision clearly states that if you are forfeiting and you are selling the house, then cost would be reduced by this amount. But if you are forfeiting, somebody else is selling, it would not be reduced. Did you get this point? If you got this point, do like the video and subscribe to the channel. I don't know how many times I'm going to ask you to subscribe till the time you don't actually subscribe it. Perfect, sir. Exemption from capital gain. Now, what it says? If you have capital gain, acha, before going to exemption, come on to chart, come on to chart, come on to chart. How can we miss out? We understood the definitions, we understood the basics, we understood the full value of concession and computed cost of acquisition. We understood the advanced cases as well. All the advanced cases have been clearly understood by us. Clearly understood, huh? Now, till this point, we are able to calculate every type of capital gain that might come our way. Now we have to understand how do we save such capital gain. How do we save such capital gain? For that matter, come on to exemptions topic. We have seven altogether, seven, no, actually nine exemptions altogether. First of all, section 54. If you are an individual or HUF and you sell any residential house property, individual HUF selling any residential house property. Okay. You have long-term capital gain. Provision says we will exempt you that long-term capital gain to you. We will absolutely exempt this long-term capital gain to you provided you buy one residential house property in India, or if your capital gain is up to 2 crore rupees, then two residential house properties in India, and this option is given only to you once in your lifetime. One residential house property you can buy, two you can also buy, but once in lifetime. Sir, till when you have to buy? Sir, if you sell it today, and in prior 1 year, if you have bought, you will get exemption. If you buy within 2 years, you will get the exemption. If you get the house constructed within 3 years, you will get the exemption. Sir, but if we are buying properties after 2 years, 3 years, how will government know that we want to claim exemption? Sir, for that matter, up to ROI, you have to deposit the capital gain amount to CGAS, capital gain account scheme. You have to deposit the amount. Sir, how much exemption would be given to us? Capital gain amount or cost of new asset, whatever the new asset we are buying, or 10 crore rupees, whichever is lower, is the amount of exemption we are going to get. Remember, whatever the new house we are buying now, that shall be minimum held for 3 years. For minimum of 3 years, that house should be held. If we sell it before 3 years, then whatever the exemption claimed earlier is shall be reduced from cost. Now, what does that mean? Understand this. For example, if I had a house acquired for 10 lakh rupees, I sold it for 50 lakh rupees. Say, okay, then capital gain amounts to 40 lakh. Now I take 54 exemption for 25 lakh rupees and I pay taxes on 15 lakh. That means 25 lakh I took exemption. I bought a new house. I bought a new house for 25 lakh. Provision says this house should be kept for minimum 3 years. Now, what if I sell this house? What would happen? Provision says when you sell this house, for example, at 60 lakh rupees, if I sold this house, then while computing cost of acquisition now, whatever the exemption claimed earlier was, that means 25 lakh, that shall be reduced from cost, and therefore no cost of acquisition would be given to us, and 60 lakh would be the capital gain amount. Whatever the exemption claimed earlier is, that shall be reduced from cost of acquisition. Did you get this point? Arey Baba, did you get this point? Provision says some extra points. If you buy two houses, for example, house number 401 and house number 402, these are two adjacent houses. That means houses side by side. You break the wall in between and you get them make one. You made them one house. From different buyers you bought this house. From different at different sale price you bought the houses. At different sale deeds you bought the houses. But you made the necessary modifications and made them one. Will it be considered as one or will it be considered as more than one? Provision says it will be considered as one only. As per Anand Baspa case law, it will be considered as one only. Sir, we got this point. We absolutely got this point. Then we have, so sometimes what happens if we are required to get the house constructed within 3 years, then whatever the cost of land is, cost of building is, everything shall be considered within for the purpose of exemption. Third thing, sir, sometimes it might happen. It might happen that I am paying consideration to buy the house, but I don't want that house to be registered in my name. I want this house to be registered in the name of my mother. I want this to be registered in the name of my mother. Can't I do that? Shouldn't I be allowed to do that? Provision says, yes, sir. Even if you register that house in anybody else's name, it will be allowed to you. Sir, why are you doing this much overacting? I am doing this overacting to make you awake. Okay? I am doing this overacting to make you awake. Now, section 54, what it says? Sir, if you are any individual HUF, you have any urban agriculture land. That urban agriculture land has been used by you for 2 years and you sell that. You can have long-term capital gain, you can have short-term capital gain. Provision says we will exempt that. If you have any long-term capital gain, any long short-term capital gain, we will exempt that. Provided by selling urban, you even buy urban land or you buy rural agriculture land. You can sell urban agriculture land, you can buy urban or you can buy rural. Sir, within 2 years you have to buy and you have to deposit the capital gain amount to CGAS account up to ROI. With that, whatever the capital gain amount is, whatever the cost of new asset is, lower of 2, we will give you exemption. Whatever the new land you are buying, you should hold that land for minimum 3 years. If you sell it before 3 years, then whatever the exemption claimed earlier is will be reduced from cost. Very important point, sir. Very important point. Now, sir, sir, for example, if I had urban agriculture land and I sold it, I got capital gain. To exempt this capital gain, I bought rural agriculture land. Can I buy this? Yes, sir. Of course, you can buy rural agriculture land. If you sold this rural agriculture land within 3 years, will it be charged to tax? Will it be charged to tax? Right answer is no. Because rural agriculture land is not a capital asset. It is not a capital asset. If you sell it within lock-in period, then to it there would be no tax applicable. Now we have section 54D. What it says? So 54D is simply less relevant. Why less relevant? See, if you have any land or building that have been used for industrial undertaking for minimum 2 years, and that has been compulsory acquired, then whatever the capital gain is being arised, that will be exempt if you buy a new land or building for industrial undertaking. So capital gain can be short term, long term, whatever the property that has been acquired. Whenever you receive compensation within 3 years of that compensation, you have to buy new land or building. Remember, whatever the capital gain or cost of new asset, whichever is lower, will be exempted to you. Whatever the new land or building you are buying, that should be used for minimum 3 years. And if you sell it before 3 years, then it will be reduced from cost of acquisition. Simple points are simple point. Really very important section 54 EC. What section 54 EC says? Open your eyes. Take a long breath. Listen. Here, we do not debate on the type of the capital gain. Capital gain can be long term, can be short term. We don't care. Capital gain can be long term, can be short term. We do not care. Only thing we care is capital asset should be long term capital asset. What did I say? What did I say? Any person who transfers any long term capital asset, being long land or building, sir, and has long term capital gain, short term capital gain, we really don't care. Asset has to be long term. Building or land has to be long term. Sir, capital gain can be short term even. Sir, it can be depreciable assets. It can be short term as well. What you have to buy? You have to buy 6 bonds. Either of the 6 you can buy. Sir, what are those 6 bonds? First of all, NHAI bonds. You can buy National Highway Authority of India. You can buy Rural Electrification Corporation Limited. You can buy Power Finance Corporation Limited, Indian Railway Finance Corporation Limited. You can buy HUDCO, which is a Housing Urban Development Corporation, or you can buy IREDA, which is Indian Renewable Energy Development Authority. You can buy any of the six bonds, and maximum 650 lakh rupees exemption you are going to get. When you have to buy these bonds, provision says from the date of transfer within 6 months you have to buy these bonds. Within 6 months from the date of the transfer you have to buy these bonds. CGS is not applicable because within 6 months only you have to buy. So CGS is not applicable. Provision says capital gain amount or cost of new asset or 50 lakh rupees, whichever is lower, will be given to you as exemption. Provision says very important. Very important. Whatever the bonds you buy now, you should hold these bonds for minimum 5 years. In addition to that, neither can you sell these bonds nor you can convert these bonds into money. So what is meant by conversion to money? For example, I have bonds, I have kept this bonds at bank and took money in return. Can I take loan in return? No, sir, you should not convert these bonds into any other manner. Provision says if I do any such conversion, it will be considered as violation. And important thing is we have to pay for these bonds within 6 months. Whether allotment is done in 6 months, we don't care. We only care whether we have done payment within 6 months. If payment is done within 6 months, then it is absolutely valid. Did we get this point, sir? Yes, sir, we get this point. Come on to section 54F. G. Come on to section 54F. Provision says if you are an individual or HF, if you are an individual or HF who sells any other assets, sir, why are you saying this accent? I don't know. I don't know. Sir, what I am saying is if you sell any long-term capital asset other than residential house property, what does that mean? For example, if you have any long-term capital asset, it can be land, it can be commercial house property, it can be gold, it can be shares, it can be any asset, which is not a residential house property. And such asset is a long-term capital asset. Sir, capital gain can be short-term as well. Capital gain can be short-term as well. In that case, whatever the capital gain is, we will exempt that provided that you buy one residential house property in India. So you sell anything other than property and you buy a residential house property. Within how much you have to buy? Sir, from the transfer, either 1 year prior you can buy, either within 2 years you can buy, or either within 3 years you can get that constructed. Whatever thing you want to do, you can do. CGAS is applicable. You have to deposit the money up in CGS up to ROI. How much capital gain we are going to exempt? Provision says long-term capital gain calculated multiplied by cost of new asset divided by net consideration is the amount of capital gain that will be exempted in your hands. Remember, whatever the new asset you are acquiring, that shall be kept for minimum 3 years. Minimum 3 years, such asset shall be held. Otherwise, what would happen, sir? We would tax such asset. We would tax the such asset. Important points. For example, if I am paying the entire sum to buy the asset, I am paying the entire sum to buy the assets, but half of the asset is being held by me and half of the ownership is with my wife. 50-50 registration, we are doing together. Can we do that? Can we do that? Of course, sir, we can do that. If I am buying half of the asset, no, sorry, I am paying for the entire assets, but registration is only half in my hands. Will I get the exemption? Right answer is yes, I will get the entire exemption. Next point. Sometimes what happens, we have to get the house constructed within 3 years. We have to get the house constructed within 3 years, but within in 3 years now, some of the minor work might be left. For example, some of the painting work, some of the walls work, some of the furniture fitting, some things can be left now. Provision says if petty work is pending, it shall amount to entire construction. Okay? That will not stop you from getting the exemption. Perfect, sir. Next, another important point. Whenever you buy a house under 54F, you cannot hold more than one house before buying. What I'm saying is, I have one house. When I claim 54F and buy another house, yes, I can claim. At the time of claiming exemption, I can have one house. Buying two would make it two. After that, I cannot claim 54F. That means at the time of claiming exemption, I can only have one house. Only one house, and the house that I'm buying will be my second house. Beyond that, I cannot claim 54F. Sir, we got that point. We got that point. There is an important provision which is I don't think is much relevant, but understand. Sir, sometimes what happens is, for example, you sold the house for 60 lakh rupees. Your capital gain was, say, for example, 40 lakh rupees. Now, assessing officer ignored this SDV, ignored this whole value. Assessing officer took the SDV, which was 80 lakh rupees. Now, while calculating the exemption, while calculating the exemption. So most oftenly what you have to do, you have to buy a bigger house. You have to buy a bigger house, because your net consideration would be 80 lakh rupees to claim the exemption. See, this is earlier, this would have been 60 lakh, net consideration would have been 60 lakh, but this has been increased to 80 lakh rupees, so you have to buy a bigger house. Now, for buying the bigger house, how much you are going to get money? See, you got only 60 lakh now after selling the house. So how you are going to get the extra money? Provision says you can bring out of your own pocket. Assessing officer will not argue anything. See, because SDV has been taken as full value of consideration, so whatever extra money we are bringing out of our own pocket, that will also be eligible for exemption. This was evidence. This was the judgment given in case of Koli Mahadevappa case law. You can ignore that. That is less relevant. Section 54G, what the section is all about. 54G, G, just go side by side. Now, if you have any person, in both the cases, if they sell any land, building, plant and machinery of industrial unit of urban area, land, building, plant and machinery of industrial unit of urban area. What did I say? Land, building, plant and machinery of industrial unit of urban area. Land, building, plant and machinery, industrial unit, urban area. Okay. And they have short-term, long-term capital gain. Any capital gain would work. What they have to buy is important. Sir, purchase, construct a new plant and machinery in rural area or shifting to that area. Purchase, construct plant and machinery in SEZ. Two basic differences between G and GA. 54G says you are selling from urban area and buying in rural areas. GA says you are selling from urban area and you are buying not in rural but in SEZ. These two sections differ at these points. Here, whatever the plant and machinery you have or land or building you have to buy a new plant and machinery when you transfer to rural areas. But when you sell here, you don't have to buy new plant and machinery. Second hand plant and machinery would also work in 54G. If you shift to rural, you have to buy new. If you are shifting to SZ, you can buy second hand as well. In both the cases, you do not get any exemption on furniture. Really important point now. It might be tested in one of the questions. It is given in your question bank. I will also upload the question bank in English if I reach the required benchmark. Now, if you have any furniture and you get any capital gain, if you have any capital gain in case of furniture, you won't get exemption here. Now, till when you have to buy the assets? Sir, from the date of transfer, either 1 year prior you can buy or within 3 years you can buy. Whatever the capital gain amount is or amount invested, cost of new asset, whichever is lower, you would get exemption. And whatever asset you buy, you should hold them at least for 3 years to continue the exemption. Otherwise, that would be taxed in your hands separately. Now, CGS, you have to deposit the sum to the capital gain account scheme up to the ROI. You are very much aware of that. Section 1037, less relevant, but yes, what it says. People from South India can relate to it. See, few years back, 2014, Andhra Pradesh or Telangana were separated. Now, Hyderabad went into Telangana, and Andhra Pradesh even today doesn't have any capital. Now, Andhra Pradesh wanted to have its own capital. For that matter, Amravati was selected. How Amravati was selected, sir? Amravati was requested to be developed one. I mean, it was supposed to become new Singapore of India. It was supposed to be made. Okay. For that matter, many of the farmers gave away their fertile land to the government so that development can take place. Now, understand from the farmer's point of view. Government has come to acquire our lands to make a city. Okay. In return, what these farmers will get? Farmers will get nothing but flats when the houses are constructed. They will get the flats when houses are constructed. So farmers might have multiple capital gain implication. Their lands are being taken away. They are getting flats in return. They don't have money right now. So to facilitate their transactions, there were some exemptions referred under 1037A. Now, what were the exemptions? Understand. Remember, whenever any of the farmers, whenever any of the person who transferred their asset, who transferred their land or building under land pooling scheme of Amravati, Andhra Pradesh, whatever capital gain is arising, that is exempt in their hands. If I am a farmer, I gave up my land, whatever the capital gain I would be having is exempt in my hands. In return, what would I get? I got a promise. I got a promise that when Amravati would be constructed, I will be given a house. So whatever the promise I am being given, that is called nothing but land pooling ownership certificate. It is a promise that once Amravati is developed, we will get a house. If I don't have any money, I might sell that LPOCs. Whatever the sale of LPOCs I will have, that will be exempt. Sir, if I don't sell the LPOCs and in future if I get a house, provision says I can sell that house within 2 years. The year in which I get the house, from that year end, within 2 years I can sell that house, and whatever the capital gain is, it will be exempt. But sir, if after 2 years I sell the house, if after 2 years I sell the house, provision says whatever the SDV as on the second year end is would be considered as cost of acquisition in my hands. Whatever the SDV that is there at the second year end would be considered as cost of acquisition in my hands. This is the benefit of Amravati. This is the people of Amravati that they have got. Okay. What is the status of Amravati? You can just watch out on YouTube. You will understand. Now, section 1037, beautiful section altogether. What it says, if you have individual and HUF who have urban agriculture land that has been compulsorily acquired and that has been used by them for 2 years, plus RBI gave the compensation, then whatever the capital gain would be arising, that is exempt. Whatever the capital gain arising is the exempt one. Now, in some questions, they might not mention this point that RBI gives the compensation or who gives the compensation, that might not be given. In that case, what would happen? You have to assume that RBI gives the compensation. So, if any individual HF has any urban agricultural land compulsorily acquired, used for 2 years, it will be exempt. This is section 1037 and this is the exemption portion. Till now, we have done the exemptions as well. Let us come on to the chart again. Let us come on to Ganji. Okay. Now we have to compute, we have to come to the taxes portion. Now, taxes portion has to be understood. Now, I don't know what is happening to the class, but don't worry. We have determination to study, so we'll study. Okay. Now, what are the tax rates? Understand this thing very carefully. What are the tax rates? Very carefully. This is the most important portion of the chapter, and this will be used in the entire syllabus. We have basically three sections. First of all is section 112A, in which whenever we have any securities referred under 112A, it is taxed at the rate of 12.5% over 1.25 lakh. Right? And up to 1.25 lakh, no taxes charged. Over 1.25 lakh, 12.5% taxes charged. We have section 111A, in which tax rate is 20%. We have section other SCCG on which slab rate is being charged, and we have section 112 on which 12.5% is charged. Now, what is the depth of the section? I will tell you one by one. Section 112. What the section 112 says: if you have any equity shares on which STT has been paid at the time of acquisition or transfer, if you have any equity oriented mutual fund on which you have STT paid on the account of transfer, or if you have any business trust on which STT has been paid on the transfer time, that means more or less they are listed ones. Can I say more or less they are listed ones? But this STT has to be taken care of duly. Okay. We can, in layman term, we can say these are listed equity shares, listed equity oriented mutual fund, listed unit of business trust. We can simply say that in layman language. If you have any long term capital gain on these securities, provision says over 1.25 lakh, you will be charged 12.5% of taxes. 12.5% taxes over 1.25 lakh. Simple thing sorted. Simple thing sorted. These securities, long term capital gain over 1.25 lakh, 12.5% of tax. Done, sir. Simple, sir. But sir, very third class category, very third class topic. Now, what this topic says? Understand this. Huh? Understand this. There are three transactions on which, even if you don't pay STT, you will be given this benefit. There are three transactions, even in which you pay the STT, you will not get the benefit. What did I say? See, STT is a very important condition for 112A. There are three transactions, even in which you pay the STT, you will not get the benefit. Three transactions, even in which you don't pay the STT, you get the benefit. Got this 2 points? Now, what are these points? Understand. For example, if I have acquired a share which was on which was acquired, if I have sold a share which was acquired before 1st October 2004, any share which was acquired before 1st October 2004, STT was not applicable now. So how can we pay STT when STT was not even applicable? So we will still get the benefit even if we don't pay STT. Second thing, transaction on which STT is not applicable, we would still get benefit on that. Even if we don't pay, we will get the benefit. Now, what are those transactions? For example, we buy shares on account of IPO. IPO STT is not applicable. We buy shares on account of ESOPs. STT is not applicable. Third thing, we buy shares on recognized stock exchange or stock exchange of IFSC. In that also STT is not applicable. So three cases, even if we don't pay STT, we would get the benefit. But three cases where even if we pay the STT, we won't get benefit. What are those three cases? First of all, you buy shares which are not frequently traded. Sir, for example, we have shares like Porwal Auto Components which are not frequently traded. Even if you buy those shares, now you even if you pay STT, no benefit is given. Second thing, you buy shares other than recognized stock exchange. For example, you buy shares from Delhi Stock Exchange, Kolkata Stock Exchange, Chennai Stock Exchange, you won't get benefit. Even if you pay STT, you won't get benefit. Third thing, if you buy shares after delisting, before relisting, even if you pay STT, you won't get benefit. But sir, benefit would be given if you buy shares on account of Supreme Court, High Court, HCLT or SEBI order, or as per FDI guidelines, or as per SEBI regulations, or from government, or on account of slum sale, or if any QIB or investment fund buy these shares, then they would still get the benefits. So what did I say? Three cases where even if you don't pay, you will get the benefit. Three cases, if you pay, you won't get benefit. Okay? Important point, sir. The major importance of section 112A. Whenever you sell any securities which fall under 112A, equity shares, equity oriented mutual funds, and business trust unit on which STT has been paid. Whenever you sell them, for these shares, cost of acquisition is taken differently. How cost is taken? Sir, you have to take the actual cost, actual purchase price. You have to take the sales value, or you have to take the FMV as on 31st Jan 2018. Of this FMV and sales, you have to take the lower one, take that figure. And this figure has to be compared with actual, whichever is higher, that shall be taken as your actual cost of acquisition. Very important point, sir. Sir, sales or FMV, whichever is lower, has to be compared with actual cost, whichever is higher, and this will be taken as your cost of acquisition. This will be your cost of acquisition. Most important point, how do we calculate the FMV as on 31st Jan 2018? For that matter, you have to check if you have shares, units of business trust, or equity oriented mutual fund that are listed on 31st Jan. If these are listed as on 31st Jan, now you have to take the highest trading price. Not average, not lowest, only highest trading price. You have to take. If no trading has been done on this day, what you would do, you would take the average trading price of the last trading session. Whenever the trading has been done last time, then now just take the average trading price of that day. Sir, but what if shares, mutual funds, or business trusts are not listed as of 31st Jan? What would we do then? You have to check. If you have mutual fund units, take the NAV. If you have mutual fund units, then take the NAV as on 31st Jan. NAV is available for every mutual fund as on that date. But sir, if you have any shares or business trust units that are not listed on 31st Jan, then what would you do? Sir, you would take the index cost of acquisition. You would take the cost of acquisition divided by year of acquisition multiplied by 272. This will give you the FMV as on 31st Jan 2018. Very important point. If you want to listen this again, listen to this point again very carefully. I'm not going to speak. You have to remind it. Huh? Now, important point, sir. What is an equity oriented mutual fund? Many faculties don't cover this. Understand this. Sir, if Rahul is a mutual fund, okay, I have 100 crore of proceeds. Out of this 100 crore, if I invest a 65% or more in listed equity shares of domestic company, then I am called equity oriented mutual fund. What did I say? If out of the total proceeds, I invest at least 65% in listed equity shares of domestic company, listed equity shares of domestic company, listed equity shares of domestic company, minimum 65%. In another way, I can become equity oriented. Now, what does that other way provision says? Provision says, if whatever the proceeds I have 100 crore, out of this 90% I invest in a mutual fund, which of its total receipts invest 90% in listed equity shares of domestic company. What did I say? I invest 90% of my money in another mutual fund which is investing 90% of its proceeds in in listed equity shares of domestic company. So either I can invest directly 65% or either I can indirectly invest 90% and the other mutual fund would be investing 90% of its proceeds in listed equity shares of domestic company. Then I shall constitute equity oriented mutual fund. I shall be called equity oriented mutual fund. But this point 1.2 is very simple. Very simple section it is. Come on to triple one. Whatever the securities have been referred under 112A, like equity shares, equity oriented mutual fund businesses on which STT has been paid, if you have any short term capital gain, then on that 20% tax would be charged to you. 20% tax flat would be charged to you. Then we have Long-term capital gain and other STCG, what does means? See, you have studied three taxation of three securities: equity shares, equity oriented mutual funds, and other on businesses. If you have long-term capital gain on these, 112 would apply. Short-term capital gain, 111 would apply. For example, if you sell any other assets, you sell gold, you sell immovable property, you sell debt oriented mutual fund, anything you sell, unlisted shares you sell, whatever else you sell. If you have short term capital gain, that would be taxed at normal slab rate. But if you have long term capital gain on such securities, then 12.5% tax would be charged to you. 12.5% tax would be charged to you. 12.5% tax would be charged to you. Got it, sir? Got it. Did you get this point? Absolutely, sir. Clear. Absolutely clear. We have an important provision for that matter. I want your full attention for next 15 minutes. For next 15 minutes, full attention. What does this point say? If you are a resident individual or HF, resident individual or HF, resident individual or HF, who transfers immovable property which has been acquired before 23rd July 2024, that has been acquired before 23rd July, and it is a long-term capital asset. Long-term capital asset or long-term capital gain, whatever it is. The individual HF, resident one, transferring any immovable property that has been acquired before 23rd July. In that case, while you compute the taxes, sir, you have to take two of lower of two. First of all is of course 12.5% of the capital gain. It is the first thing that you have to do. The second thing you have to do is 20% of capital gain considered with indexation. With indexation. 12.5% without indexation, 20% with indexation. Now, to understand indexation, we shall come on to the old provisions that we have in our syllabus. Old provisions in our syllabus. What are these old provisions? Understand. If any, see what is indexation, I am telling you. Section 48, Proviso 2 talks about indexation. What is this indexation? Provision says if you have any long-term capital asset which was transferred before 23rd July 2024. That means this is an old provision. This is an old provision, 23rd July 2024. Any asset that was transferred before 23rd July 2024. Old provisions, sir, very old provisions. Then whatever the cost of acquisition is, you shall index that cost of acquisition. How do we index that? Sir, cost of acquisition divided by CII of year of acquisition. That means the CII of the year in which you acquired that asset multiplied by CII of year of transfer. Now, what is the CII list? So, CII list is 100, straight away starting from 1 to till today you have 376. For your attempt, CII is 376. If asset is being transferred in 25-26, then indexation would be 376. But indexation is only applicable for the asset transferred before 23rd July 2024. Sir, what if my asset was acquired before 1st April 2001 and 2? What if? In that case, what would happen? Sir, you have to take the FMV. Actual cost or FMV, whichever is higher. Sir, but immovable property, we can have SDV as well now. Provision says in case SDV is available now, provision says your FMV cannot exceed the SDV. What does that mean? Sir, for example, if I am selling a house whose FMV is 1 crore, but stamp duty value is 60 lakh rupees. Provision says your FMV cannot be 1 crore then. Your FMV cannot exceed the SDV amount. Your SDV would be 60,000 only. So your FMV would be 60,000, 60 lakh only. If SDV is not available, then whatever FMV you have, that shall work. Sir, whatever improvement you have done, the improvement will also be indexed if cost of acquisition is indexed. Remember, whatever improvement have been done up to 1st April 2001, that shall be completely ignored. Why did we understand this indexation provision? So indexation provisions are important for some cases. And that cases we have to study now. Understand these cases, important cases, sir, important, very important cases. Sir, indexation is important in 4 important cases. Very important, sir. Sometimes it might happen that transfer took place in some other year, but tax is charged in current year. Transfer took place in some other year and tax is being charged in the other year. Just say, for example, if we have destruction of capital asset, if I have a capital asset, if I have a house that is destroyed, that has been destroyed. For example, it caught fire, it got civil turbulence, it was destroyed. So tax is not charged in that year, tax is charged in current year now. Similarly, if I have a capital asset which is converted into stock in trade, taxes charged in the year in which stock in trade is sold. If we have any capital asset which is compulsorily acquired, taxes not charged in compulsory acquisition year, it will be charged in the year in which money is received. Or if you have joint development agreement, taxes not charged in the year in which the asset was given to the developer, but it will be charged taxes in the year in which completion certificate is issued. So in these four cases, the transfer year is some different, but tax year is something different. Why am I telling you this thing repeatedly? Because it might happen that in exam you are given with a question where transfer took place before 23rd July 2024. In these four cases, it is possible that transfer took place before 23rd July. Then what would you do? You have to index the cost of acquisition as well. Somebody who is listening carefully, do give a point. Do mention this point in the comment section. Do mention timestamp so that everybody is able to understand. If transfer took place before 23rd July, then in these four cases, it is possible that you might have to index the cost of acquisition, index the cost of improvement. Now, what happens in these four cases, let's understand one by one. See, if we have any destruction of capital asset, what would happen? For example, if I have any house which got destroyed, it might happen that house was destroyed in some other year, but capital gain would be charged in the year in which compensation is received. Compensation from insurance company or any house is received in return. Provision says full value of consideration would be the insurance money that I get, or FMV of the house that I get, that will be the full value of consideration. Minus I have to do cost of acquisition. I might have to index the cost if transfer took place before 23rd July. That will be reduced, and this will give me long-term, short-term capital gain depending upon period of holding. That is the first important case. Second thing, conversion of capital asset into stock in trade. What this is all about, this is also very important. For example, I have a piece of land. I have a big piece of land acquired way back. Now, on 1st April 2020, I wanted to convert this piece of land into stock in trade. I want to make houses and I want to sell this house to the normal public. Provision says transfer took place in this year only. The tax would be charged in the year in which actually I am able to sell that stock in trade. Important point here is whenever I transfer took place before 23rd July, indexation would apply. Remember, indexation would apply. How much capital gain would be arrived? See, the date on which we converted this asset, now on that day, capital gain would be fixed. But it would be only charged to taxes in the year in which we actually sell the stock in trade. And whatever the proportion we are able to sell, the proportionate capital gain would only be taxed. For example, whenever I convert this, full value of consideration will be FMV on the date of conversion. Whatever the FMV, fair market value as on the date of conversion is, that shall be considered as full value of consideration. Minus cost of acquisition, this will give you long-term, short-term capital gain. This capital gain would be charged to tax in the year in which the house is the stock in trade is sold, and whatever the proportionate capital gain is, that will be only taxed. Sir, similarly, we'll have PGBP sales value minus cost of acquisition, and whatever the FMV was, that shall be considered as cost of acquisition for the purpose of PGBP. Basic provision, not difficult at all. Important provision is the next thing that I'm going to tell you. If you remember, few minutes ago we understood section 54 EC. If we have any long-term capital asset being land or building and we transfer it, we can claim exemption by buying bonds of 6 companies: NHAI, RECL, PFCL, IFCL, IREDA, HUDCO. We can buy any 6 bonds. But sir, bonds have to be bought within 6 months from the date of the transfer. Bonds have to be bought within 6 months from the date of the transfer. But sir, here transfer took place in 2020, but I am getting money to buy bonds in 2026. How we will be able? How we will be able in the God's name to buy assets within 6 months? How can we buy within 6 months? Provision says, therefore, under 54 EC, you don't have to buy bonds within the date of the transfer. You don't have to buy bonds from the date of the transfer. Rather, you have to buy the bonds from the date on which actual property is sold, actual stock in trade is sold. Remember, you don't have to buy the bonds from the date of conversion. Rather, you have to buy the bonds from the date on which actual stock in trade is sold. Got this point, sir? What Anubhav is saying, sir, salute to your dedications. You are working day and night for us. Most welcome, Anubhav. Most welcome. Now, the fourth and third important case, what is compulsory acquisition? Now, what happens? For example, I have a house. Okay, I have a house. And all of a sudden, government wants this house. Government wants this house and government wants to construct a temple here. Any way they want to construct a temple. For that matter, they would announce some initial compensation. They will say, "Oh, Rahul, we are taking this house now. We would give you 10 lakh rupees as compensation. 10 lakh, 20 lakh, 30 lakh, whatever." The first thing that they announce is nothing but initial compensation. What did I say? Whenever government compulsorily acquires under any of the law any property from my hand, provision says first thing that they announce is initial compensation. And when I challenge that compensation in court, the additional compensation that I get is enhanced compensation. Two compensation we get, we have to understand taxation of both of them separately. Now, how things go understand. Initial compensation is taxed differently. Provision says, for example, if my house was acquired and initial compensation was announced, say 50 lakh was announced. Provision says, out of this initial compensation, whatever the compensation you are receiving, whenever you are receiving the first installment, now, entire initial compensation will be taxed. What did I say? Understand. Out of if I am given 50 lakh of initial compensation, out of that I have only received 10 lakh of initial compensation as first installment. Provision says at the time of first installment only, entire 50 lakh would be taxed in your hands. Entire 50 lakh would be taxed in your hands, minus cost of acquisition, minus cost of improvement, and this will give you capital gain. So first compensation, initial compensation will be taxed when I receive the first installment. Sir, what will happen? What will happen to enhanced compensation? Provision says enhanced compensation will be taxed in the year when it is received. As and when received. Full value of consideration would be enhanced compensation minus litigation expenses, if any, and this will give you long-term, short-term capital gain. Remember, what will happen to cost of acquisition? Do we get deduction of cost of acquisition here? Right answer is no, we do not get. Why? Because already taken, na? Already taken cost of acquisition here. Whatever the nature of initial compensation is, if it is long term, then enhanced compensation will also be long term. If initial compensation is short term, then enhanced compensation shall also be short term. Third, sometimes what happens is government took my house. Government took my house. 50 lakh was the initial compensation. And I immediately went to court. Immediately went to court. I am sure that some extra money I should be getting. I am 100% sure that some extra money I should be getting. Court heard this matter and announced the enhanced compensation of 1 crore rupees as on interim order basis. Interim order basis means the court has not finalized the order, but court is sure that 1 crore is the minimum amount that should be given to me. Court is sure that 1 crore has to be given to me. In that case, what would happen? Sir, uh, as per interim order, it gave me 1 crore rupees of enhanced compensation. Provision says if any enhanced compensation is received on account of interim order of the court, enhanced compensation received on account of interim order of the court is not taxable right now. It is only taxable when final order is received. When final order is received, it is taxable then only. Done, sir. Whenever we receive any interest on enhanced compensation, what would happen to that? Provision says it is taxable in your hands only under IFOS head. It is taxable under IFOS head, and you get 50% of standard deduction. 50% standard deduction you would get. Done, sir. Done, sir. Done, sir. Done, sir. Perfect, sir. Hmm. Sometimes what happens is, for example, I have been given compensation of 50 lakh rupees. Later on, court thinks that this is also extra that has to be refunded. For example, 25 lakh is only to be given, so I have to refund this money, and therefore a rectification in that sense would be made. A rectification would be filed by the AO. AO will do the rectification in that return. Now, same thing. So some important things understand. We understood section 1037. What is 1037? If you are any individual HUF, you have any immovable property that has been compulsorily acquired, sorry, not immovable property, but urban agricultural land that has been compulsorily acquired, you use them for 2 years. So whatever the capital gain would arise, that is exempt. We understood this point. We understood this point. Sir, sometimes it might happen that you don't want to argue. Whatever the initial compensation has been given to you want to increase that, so you went to collector. You did not go to court. You did not argue for the enhanced compensation, you went to court. Sorry, you did not go to court, you went to collector for increasing the enhanced compensation. Sir, what assessing officer did? Assessing officer considered this to be a voluntary sale. I have not argued in the court. On that basis, assessing officer considered it to be a voluntary sale. It is absolutely an invalid argument. Just because I did not go to court for argument purpose does not mean that it is not a compulsory acquisition. It is definitely a compulsory acquisition. So there is a section called Section 96 of Right to Fair Compensation, Transparency, Land Acquisition, Rehabilitation, Resettlement Act. If you receive any compensation in that act, it is absolutely exempt. If you receive any compensation in that act, it is absolutely exempt. Now we have section 45(5)(a), that is joint development agreement. Now what is this joint development agreement? See, if I have house and I have no money, and there is a developer called Lodha developer who has money but no plot, so I can give my house to Lodha developer. He would do the construction purposes, and in return he would give me 6 crore rupees in cash plus 6 flats in return. He can give me anything. Provision says this is nothing but a joint development agreement. If I have property and I give this property to developer, and developer would construct the house, he would give some flats to me, some money to me, and remaining he would sell off his own to earn his cost, to recover his cost. This is joint development agreement. In this case, what would happen if you are an individual or HUF? You transfer your house property to any of the developer. Provision says the year in which transfer took place will not be charged to taxes. In that year, taxes wouldn't be charged, but taxes would be charged in the year in which completion certificate is received by Lodha developers. When completion certificate is received by Lodha developer, in that year tax would be charged. How much would be amount of full value of consideration? See, if I receive 6 crore rupees, then 6 crore money is the full value of consideration. Plus, if I receive flats, for example, I receive 6 flats of 50 lakh each. Provision says then 3 lakh shall also be considered. 3 crore would be also full value consideration. So whatever the money I get and whatever the SDV I get, adding both of them will give me full value of consideration. Minus cost of acquisition, cost of improvement, so that will be reduced, and this will give me long-term, short-term capital gain. The three important pointers in this provision. Three really very important provisions. So first of all, this section is only applicable to individual HUF. If you are an individual HUF who transfers this property, then only this benefit is given to you. This benefit is given only to individual HUF, not to anybody else. Done, sir. We got this point. We absolutely got this point. If you are an individual HUF, then only this benefit is given to you. Listen, listen. Sir, sometimes what happens is Rahul has a land. He gave this land to a developer. In return, he is being promised 6 crore of cash plus 6 flats of 50 lakh each. Rahul sold this flat immediately. Immediately, I sold this flat. Provision says if any of the assessees before getting the completion certificate received, he sells the asset. If I sell the asset, what would happen? Provision says I will be charged to taxes. What does it mean? See, completion certificate is not issued yet. Completion certificate is not issued yet, but before completion certificate only, if I sell the assets now, then capital gain would be charged in my hands today only. Why that is so? Because this exemption was given to you because I had no money when I was transferring the asset. But if I got the money by selling the rights before receiving the completion certificate, then capital gain would be charged right now only. Therefore, if I sell it before completion certificate, then tax would be charged before only. Another important point, for example, Rahul has a land and in return, this land was given. This land was given to, for example, Lodha developer, and in return, he was given 6 crore rupees cash plus 6 flats of 50 lakh each. Whenever I will sell this flat, now for example, I sold this flat for say 1 crore rupees. Provision says cost of acquisition will be nothing but the SDV of the flat. That means 50 lakh will be considered as cost of acquisition. This will be considered as cost of acquisition. This is about the joint development agreement. These four cases are really, really important. Why I am saying this thing again and again? Because, sir, in these four cases, examiner might trick you. He might give a date of transfer before 23rd July. In that case, you have to do the indexation as well. Therefore, remember this point very carefully. You cannot skip this point out. You really cannot skip this point out. Therefore, you must remember these four cases. If somebody is watching, do give a timestamp on this point. Sir, again come on to that last portion. What are the last few portions left? Understand? Only last 2 or 3 portions. See, if we have some income, if we have income under section 112A or 111A or 112, if we have any capital gain under these three sections, will I get any chapter 6A benefit? Will I get any deduction under these sections? Right answer is no. No deduction is allowed against the incomes under these three sections. No deduction is allowed under these three sections. No deduction is allowed. Sir, do I get basic exemption limit benefit? So that 2.5 lakh basic exemption limit, 4 lakh basic exemption limit benefit against these three incomes. Right answer is we need to understand. See, basic exemption limit available. If you are a non-resident now, then no basic exemption limit benefit. No basic exemption limit benefit available. If you are a non-resident, you are earning even a rupee of capital gain, you have to pay the taxes. No benefit of basic exemption limit is given to you. But if you are a resident, and if you are any AOP, if you are a BOI, or if you are an artificial juridical person, again no basic exemption benefit is given to you. But if you are any individual or HF, you are given basic exemption limit benefit on these three incomes: 112A, 111A, and 112. Do you get basic exemption limit on lottery income? No. Online gaming income? No. Sir, cryptocurrencies income? No. Carbon credit income? No. You don't get basic exemption limit on any income which is taxed at special rate except for these three incomes, and only on these three incomes, only after using the general income. First of all, you have general income for 3 lakh rupees. That means first this 4 lakh is to be used from this general income, and remaining 1 lakh is to be set off from this. That means first of all, income which is taxed at slab has to be used from basic exemption limit. Then remaining of the basic exemption limit is to be used from this limit. Only these three incomes will be saved. Sir, do we get rebate under section 87A on these basic on these incomes? Do we get rebate under 87A? See, 87A rebate under old tax regime versus new tax regime is important. If it is old tax regime versus new tax regime, that is 87, so 115 BAC, you don't get any rebate of 87A on any special income. If you have any income which is taxed at special rate, now you don't get rebate under 115 BAC. If you are paying taxes under 115 BAC, you don't get rebate of any special income taxed. Any special income which is taxed at special rate, you don't get rebate on that. But if you follow the old regime now, then you get a rebate on all the incomes except 112A. Except 112A, you get rebate on every other income. Every other taxes you get the rebate, but under 112A you don't get. I hope things are really very clear. Sir, when an asset is considered to be stock in trade, when an asset is considered to be capital asset, why it is important? Because if it is stock in trade, then it is PGBP. If it is capital asset, then it is considered as capital gain. Sir, how do we decide that? We have four basic pointers. We have exempt income yet to be done. You listen to these points carefully. We have some important pointers yet to be discussed. Now, how do we decide that whether it is a capital asset or stock in trade? First of all, is you have to check the treatment in the books of the SSC. If SSC himself treats us as capital asset, you have to assume capital asset. If SSC treats as stock in trade, you have to assume stock in trade. Period of holding period. If SSC holds the assets for very long, that means it is a capital asset. If quantum of purchase and sales is very high, that means it might be stock in trade. If objective is earned to dividend, then it is a capital asset. See, if your objective by keeping the securities is to earn the dividend now, then it is capital asset. If the objective is to earn from price fluctuations, then it is stock in trade. These four things are very important. How do assessing officer decide while deciding whether it is stock in trade or capital asset? Remember, assessing officer will take care of the four pointers. Second thing, assessing officer will first of all check if assessee has himself treated as stock in trade. If you sell shares and you treat it as a stock in trade, provision says there is no way that AO is going to argue. AO is not going to argue. AO is for sure going to take this. AO is for sure going to accept it. Third thing, sir, if you have listed shares, which you can sell anytime, but you hold them for more than 12 months, you offer that under capital gain, then AO is not going to argue. AO is not going to argue. See, it is logical. Now you have listed shares and you're holding them for more than 12 months and offering income under capital gain. That means these are capital assets only. These are capital assets only. Therefore, AO is not going to argue. Last thing, if you have unlisted shares, unlisted shares are normally capital gain only because normally you do not sell unlisted shares on regular basis. But if genuineness of the transaction is questionable, or if transaction relates to corporate wheel lifting, that means some fraud or something like that, in that case AO can change the characteristic. Otherwise, by default, whenever you have any unlisted shares, it is capital gain only. So section 55 a reference to valuation officer. Sir, if AO feels like whatever the FMV has been given by the SSC is wrong, he can refer the case to valuation officer. If he thinks the difference is more than 15% or 25,000, he can refer the case. Or if he feels any other reason, then in that case, he can refer the case to valuation officer. So there is a concept. See, for example, if you sell a house, if you sell a property, which is a land plus building, Sir, land might be very old, maybe 20, 30-year old, but building is just less than 1 year old. For example, you sold them, both of them, for 10 crore rupees. It might happen, land might be very old, but building is very new. In that case, what would happen? Provision says whatever the capital gain happens in case of land, that will be long-term capital gain. If it is building, it will be short-term capital gain. How would we segregate the full value of consideration? Provision says based on FMV, you are going to segregate the full value of consideration. Perfect, sir. Perfect, 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 sir. Yes, sir, perfect. Now come on to the chart. Where do we stand right now? Where do we stand right now? Sir, we understood the tax rates. We understood the set of provisions. We understood the old provisions as well. Now we have some provisos left. We have some exemptions left. Only two things are left to us, and then we will be done with the entire chapter. Come on to provisos first, and then we'll come on to exempt income. Almost we are done with almost all the provisos, but one proviso we need to understand. Very important point. Huh? Very important point. What this proviso talks about. Understand this very carefully. This is a real life situation. For example, in 2016, there is a person called Joey Tribbiani. He came up with 10,000 US dollar. At that time, exchange rate was 60 rupees. So he invested 6 lakh rupees in India. He invested 6 lakh rupees in India. Where did he invest? Sir, he invested in Rahul Private Limited. He invested in Rahul Private Limited. After years of hard work, share prices of Rahul Private Limited grew. They skyrocketed. And as of now, shares of Rahul Private Limited are 9 lakh 20,000 rupees. These 6 lakh rupees grew to 9 lakh 20,000 rupees. Wow. What a gain to Joey Tribbiani. What a gain. Wow, sir. Wow, 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 wow. What a gain. As soon as Joey felt he wanted to take that money back, he sold these shares and converted this money into dollar. At that time, exchange rate has gone up to 92 rupees. Now, again, when he's taking back, he's just taking $10,000 only. And Nimotai, on the other hand, is shouting out loud, Joey, pay the taxes on 3 lakh 20,000 because sales value is 920, cost is 6 lakh rupees. So, capital gain is 320, pay taxes on that. Joey, Nirmala Tai is asking for taxes. But in fact, if you see now, he has not earned anything. He has not earned anything. Are you getting this point? Are you getting this point? Because of foreign exchange fluctuations, because of rupee depreciation, or you can say because of dollar appreciation, his actual gains are zero. His actual gains are zero. It might appear that he is earning, but he is not earning actually. So what would happen? So in that case, first proviso to section 48 would come into picture. Provision says if we have any non-resident or any foreign company who invest into unlisted securities of India, not listed, unlisted securities of India, then capital gain shall be calculated in foreign currency. Whatever the capital gain would be calculated, it will be calculated in foreign currency. How do we calculate the capital gain, sir? Full value of consideration would be calculated, whatever the rupees calculation is, that will be converted to dollar. With an average rate, average buying plus selling divided by 2, this average rate on the date of sale, this will be used. Transfer expenses in rupees would be also converted with the average rate of buying and selling as on date of the sale. This will give you the net consideration. Now you have to reduce cost of acquisition. Now cost of acquisition would be considered, would be taken with the average rate of buying and selling on the date of buying. Buying date would be used. Then you would arrive the capital gain, and that capital gain would be in dollar, and this will be considered, this will be calculated with buying rate on the date of the sale. Buying rate on the date of the sale, this is the rate at which capital gain would be converted. This is how you are going to solve the questions. We have another proviso, third proviso, which says if you have any listed securities, on listed securities now we have no concept of indexation, not even before 23rd July, not even after that, we don't have concept of indexation. Plus on listed securities, first proviso, this foreign exchange fluctuations shall also not apply. Other provisos are not relevant to you at all. This is the entire provisos. Now come on to exempt transfer portion. Last topic, and I should say the most important topic. I don't know why ICI loves this, and ICI tries to ask most of the questions from this topic. I don't know why. From recent attempts, I have seen questions being asked in this topic a lot. Now, what is an exempt transfer? Last topic of the session. These transfers qualify as transfer under section 214. Whenever we talk about transfer, they fall within the definition of the transfer. But they are exempt specifically under section 47. That means no capital gain in whatsoever sense is going to arise in these following cases. What are these cases? Understand one by one. First of all, if there is an HUF, okay, AHUF, member 1, member 2, member 3. There is partial partition, and this on account of partial partition, this asset is being given to some of the members who are being partitioned. Then in that case, no capital gain, no transfer. If any of the asset is being transferred by the HUF to the member on account of partial partition, no capital gain. Asset being transferred from HUF to member on account of partial partition, no HUF. Similarly, for example, we have a HUF, AHUF, member 1, member 2, member 3. HUF is being totally partitioned and assets are distributed. In that case, no capital gain in case of HUF. So even if it is partial partition or total partition, no capital gain whatsoever in case of HUF. Next point, if you are an individual or HUF and you gift any capital asset or you transfer your capital asset on account of will, then no capital gain whatsoever. If you gift the capital asset to anybody else, now no capital gain in your hands. If you transfer your assets under will, then no capital asset, no capital gain in your hands whatsoever. Sir, got this point. Third thing, sir, if you are a company and you have 100% subsidiary, 100% subsidiary, if you transfer any of the capital asset to subsidiary or your subsidiary transfers any of the capital asset to you, sir, it is absolutely 100% exempt. If a 100% parent company transfers assets to 100% subsidiary company, it is absolutely exempt. It is absolutely exempt, but sir, remember there are certain conditions attached. Sir, recipient has to be Indian company. If parent is transferring to subsidiary, subsidiary has to be resident. If subsidiary is transferring to parent, then parent has to be resident. Second thing, sir, this parent subsidiary relationship shall subsist for at least 8 years. Shall subsist for at least 8 years from the date of transfer. Sir, we are not discussing about stock in trade, because if we are discussing stock in trade giving is not a transfer in itself. We are talking about capital asset, we are talking about capital gain. So stock in trade transfer is not dealt in this section. If parents transfer any asset to subsidiary, if stock in trade is being transferred, it is not dealt here. It is not dealt here at all. Third important condition, sir. Third important condition is, sir, whenever recipient shall not convert such asset into stock in trade. For example, if we have a parent who transfers a land to subsidiary and subsidiary converted this land as a stock in trade, provision says no, it is not allowed. At least up to 8 years, it is not allowed. So what did I say? Parent transferring asset to 100% subsidiary or 100% subsidiary transferring assets to parent, it is absolutely exempt provided three conditions are met. First condition, whatever the transfer is happening, recipient should be Indian company. Second thing, sir, parent subsidiary relationship should be held for minimum 8 years. And third thing, sir, the recipient shall not convert such capital asset to stock in trade for at least 8 years. Done, sir. Transfer in case of amalgamation or exempt transfer in case of amalgamation. Now, what is an amalgamation? Understand. Under Income Tax Act, if we have two companies, A plus B, if they become AB, it is also amalgamation. You might say it is joint venture, but it is amalgamation under Income Tax Act. If A plus B becomes A, you might call it acquisition, but it is amalgamation under Income Tax Act. A plus B, if it becomes B, you might call it acquisition. It is again amalgamation under Income Tax Act. If A plus B becomes C, you might call it a merger. Again, we would call it as amalgamation. So whatever terms you have understood in accounts, it is irrelevant. We call it amalgamation here only. Now, we have a classic example of Zomato Blinkit case. Zomato, or I should say Blinkit, amalgamated with Zomato a few years ago. Blinkit amalgamated with Zomato. Now, how can we call it a valid amalgamation? Provision says if all the assets of the amalgamating company becomes asset liabilities of the amalgamated company. That means whatever the assets this Blinkit has, that shall be transferred to Zomato. In that case, it is a valid amalgamation. If all the assets of the Blinkit are being transferred to Zomato, it is a valid amalgamation. In addition to that, whatever the shareholders are of Blinkit, at least 75% of the shareholders shall become shareholder in the Blinkit. If both of these conditions are satisfied, it is a valid amalgamation, and whatever the transfer happens are exempt. Sir, what are the transfer happening? For example, Blinkit has multiple dark stores. Multiple outlets, provision says all these assets are being transferred to Zomato. So there is transfer of assets happening. Provision says any assets transferred by amalgamated company to amalgamated company, it is an exempt transfer. Any assets transferred by Blinkit to Zomato, it is absolutely exempt. Second important case, sir, for example, Rahul. We have Rahul. I have shares of Blinkit. I have shares of Blinkit. Forcefully, not willingly, but forcefully, my Blinkit shares were being taken, and unnecessarily I was given shares of Zomato. Forcefully, shares of Blinkit were taken, and I was given shares of Zomato. I was not even willing to get them, but I was given forcefully. Provision says if you give shares of if Rahul, if Rahul surrenders the shares of the amalgamating company, if my shares are being taken away and in return I am being getting the shares of amalgamated company, so it is a type of transfer happening. My shares, my right in the Blinkit are relinquished, transfer happening. Therefore, it is an exempt transfer under section 47. If my right in an amalgamated company are being extinguished, it will be exempt transfer. Next point, understand this thing. Huh? For example, this is Rahul. Not Rahul actually, this is Geo. If you know, shares of Geo are being held by Facebook. At least 10% of the shares are held by Facebook. All of a sudden, this this Facebook amalgamated with Meta. Met with Meta. Now, what happens in this transaction? Understand this. Earlier, as a Geo, my shares were held by Facebook. Now these shares have been held by Meta because Facebook merged with Meta. Earlier, shares were held by Facebook. Now shares are being held by Meta because they amalgamated with each other. So there is a transfer happening. Provision says if any two foreign companies amalgamate with each other now, then in that case it is exempt transfer. If Indian company is being transferred, then it is exempt transfer. Oh wow, sir. Oh wow. And at last, if two banking institutions, if any banking institutions take place now, if any banking institution merge, then it is an exempt transfer. For example, Dena Bank plus Vijaya Bank plus Corporation Bank, sorry, not Vijaya Bank, Corporation Bank plus Union Bank became Union Bank now. So it was exempt transfer for Vijaya Bank and Corporation Bank provided that it was as per Banking Regulation Act. Perfect, sir, perfect, sir, perfect. Amalgamation in case of demerger. Understand this thing also very carefully. Amalgamation, what does it, sorry, demerger, what does it mean? See, we have a company called Reliance, out of which a company demerges, which is Geo Financial Services. Here, Reliance is demerged company, or Geo Financial Services is resulting company. Provision says whatever the assets this Reliance are giving should go to Geo. It should not go to anybody outside. First condition. Second thing, whatever the assets that have been given by Reliance to Geo Financial Services, they should be recorded at book value, no fair value at all. But sir, what if this Geo follows Ind AS? If it follow Ind AS, then it has to record at fair value. Then provision says if the resulting company follows the Ind AS, then you can record at fair value. Ideally, they should record at book value, but if the resulting company follows Ind AS, then Ind AS should be followed. Third thing, Geo Financial should be issuing shares only, no money. So Reliance giving shares, Geo issuing shares. That's it. Then whatever the shareholders are of Reliance, Reliance had multiple shareholders. At least 75% of the shareholders shall become shareholder in Geo Financial Services, and at last, this business shall be transferred as going concern basis. If all the five conditions are fulfilled, then it is a valid demerger. It is a valid demerger. Provision says it is a valid demerger. In that case, what would happen? Certain transaction would be exempt transfer. Let me tell you what. For example, in Reliance, many assets went to Geo Financial Services. Multiple assets went to Geo Financial Services. Provision says if asset go to Geo Financial Services, then this transfer is exempt transfer. This is an exempt transfer. Got this point? Sir, you are a diamond. You will definitely achieve star one day. Very nearest. Oh, bhai sahab. Thank you so much, Sandeep, for your kind words. Really, thank you. Now, another important point. This is difficult to get understand this. For example, this is Reliance, and this is Geo. Rahul had shares of Reliance, which was 1500 rupees. And out of this, some assets went to Geo Financial Services. So my Reliance share was parted into two parts. One into Reliance of 1350 or 150 of Geo Financial Services. So I had one share which was parted into two parts. It was parted into two parts. It was divided into two parts. First part is the Reliance shares, the other part is Geo shares. Then I simply say that this partition shall also be transferred. Provision says ideally it is transfer, but it is not, it is an exempt transfer. Surrender of the shares by the shareholders of the demerged company for receiving the shareholders of the resulting company, it is absolutely exempt transfer. If partition taking place now, I am surrendering some value in the Reliance, that means it is exempt transfer because I am getting the same value in return in the form of Geo Financial Services. Third thing, this is also difficult to get, try understanding this. This is also difficult to get, try understanding what does this mean. Now, for example, we have Geo. As of now, Geo share are being held by Meta. Meta holds 10% of Geo. Out of that Meta, Facebook demerges. And on this demerger, Facebook receives this 10% share. Facebook demerges and receives. Sir, Reliance, sorry, Geo has shareholder as Meta, and now shareholder is nobody but Facebook. Because of demerger, Facebook got the shares. So at the time of demerger of two foreign companies, shares of Indian company are being transferred. Provision says it is an exempt transfer. It is also an exempt transfer. Now, next important points are sovereign gold bonds. See, if you have any sovereign gold bonds, see, sovereign gold bond is nothing but a big shock to the people who saw the budget 2026. But that is not our subject matter. Budget 2026 is not applicable for your attempt. Understand? Huh? Now, sovereign gold bonds. If you are an individual who have sovereign gold bonds and who hold such sovereign gold bonds till maturity, it is absolutely exempt in your hands. But if you transfer before maturity, then capital gain would be applicable in your hands. If you are any other person other than individual, that means HUF, AOP, BOI company, any other person who has sovereign gold bonds, it will be taxable even at maturity, even before maturity. And whatever interest you receive on sovereign gold bond, it is always taxable. So point says, if you are an individual who hold the sovereign gold bonds till maturity, then capital gain is exempt. Now, if you transfer any of your house in reverse mortgage scheme, now for example, I'm very old person, 70-year-old person, and I have just a house. No child whatsoever, no wife whatsoever, nothing. I have one house. I have no money as well. Now, how do I survive? I went to bank and requested bank, can you take this house and in return just give me 1 lakh rupees per month till the time I am alive. Whenever I die, you can take my house. I am making an arrangement in which I am giving my house in advance. I am giving the property, I am giving the papers of my house in advance and asking money in return. Now, whenever I will die, what will happen? This house would go to bank. This house would go to bank. Now, in this case, what is happening? See, I am receiving everything. I am receiving per month. Ultimately, in loan, what happens? I have to pay the money, but I am receiving. So it is a reverse mortgage scheme. And what would happen? Provision says whatever the money I am getting, that is absolutely exempt. Whatever the money I am getting is absolutely exempt. If my house is being transferred to bank, that is also exempt. Under reverse mortgage scheme, if any house is transferred, it is absolutely exempt. But the money I am getting, that is also absolutely exempt. Then we have, if I have any shares as per stock lending scheme. Now see, what happens whenever I want to do the, if I want to, for example, do short selling. If I want to short selling, so I might require shares to be borrowed from somebody else. You have seen this in AFM that you can borrow shares from somebody. Now, if you borrow shares from somebody and you have right to sell them, ultimately it should amount to transfer. If you are borrowing shares from somebody and you are allowed to sell them also, you are allowed to buy them also, it amounts to transfer now. So provision clearly exempts this transaction. Provision says if shares are being taken under stock lending scheme, if you have borrowed such shares, then it shall not amount to transfer. Borrowing shares shall not amount to transfer. Now, one day I was just painting. Okay? This was the donkey I drew. A donkey. Another donkey I drew. Okay? And on above, over above, I drew myself. And over above that, I drew Indian flag. And I named this painting as a nation. So now, why did I name it? See, as implies a donkey, another as implies donkey, I implies me, and over me it is nation. I named this painting assassination. Now everybody went mad. Mukesh Ambani was fighting. He gave me 100 crore rupees check just to get this painting. Anil Ambani also went into race. 80 crore rupees he gave me just to get this painting. Sir Lakshmi Narayan Mittal Saab gave me 120 crore rupees. But ultimately, I donated this painting to National Museum for just 1 lakh rupees. Provision says if you have any kind of art, archaeological collection, manuscript, book, photograph, or print, if you give to government, university, national museum, art archive, even if you receive some nominal sum, that is exempt. Sir, transfer of shares of SPV in exchange of units of business. What does that mean? Sir, for example, this is Rahul. Rahul hold 5% shares in G Private Limited. And there is a business trust who holds 70% in this G Private Limited. Now, what happens? Understand. This company is a SPV because more than 50% are being held by business trust. This is a SPV. If business trust hold more than 70% in any of the company, it is nothing but SPV. Rahul holds 5%. All of a sudden, business trust came on to me and requested these 5% shares. I said, what will I get in return? Business trust said, I will issue you my units. You just give me shares. Give me shares and I will issue my units. Just imagine, I have shares which are being taken away, and in return, I get just units. I have shares that are being taken away, and in return, I get units. It amounts to transfer. Provision says that is exempt transfer. If transfer of shares happen in exchange of the units of the business trust, it is exempt transfer. Now, transfer of capital. See, if they have any predecessor cooperative bank which converts into a bank, which converts into successor cooperative bank into banking reorganization, if any infra financing company converts into institution for finance, or if any public sector company merges with any of the public sector company under central government scheme, then any transfer is exempt transfer. Now we have two mutual fund related exempt transfer. These are very good pointers to be understood. See, if we have two equity oriented mutual funds, one equity oriented mutual fund merges with equity oriented mutual fund, it is exempt. If debt oriented mutual fund plus debt oriented mutual fund merges, it is also exempt. These are exempt. Equity oriented merging with equity oriented and debt oriented merging with debt oriented, these are exempt. Vanch, hi sir, hi Vanch. Perfect. Now listen to us. Listen. One point very carefully. If any equity oriented mutual fund merges with debt oriented mutual fund, will it be exempt? Right answer is no, it is not exempt. It is not exempt. Let me take one example. For example, Rahul has Nippon India Growth Fund. I have 1,000 units of 100 NAV. All of us, this is an equity oriented mutual fund. Now, now, so this equity Nippon India Growth Fund was consolidated with Nippon India Wealth Fund. They both were consolidated. In return, I got 1,000 units of NAV 120. Earlier value of mutual fund was 1 lakh. New value of mutual fund is 1.2 lakh. So ultimately, in just exchange of these units, I got benefit. In exchange of these units, I got benefit. Provision says whatever exchange that happened, whatever benefit you got, that is absolutely exempt. Absolutely exempt. So similarly, if you have, for example, a dividend plan and that dividend plan was switched to reinvestment plan, if there is switching between the plans, now that is also exempt. Very important point, sir. Very important exemption. Try to focus on this very carefully. If any proprietor converts itself into company, partnership firm converts itself into company, or if any company converts itself into LLP, there are certain exemptions. Not just one, but there are multiple exemptions. Try understanding them one by one. Sir, if a proprietor converts itself into company, there are multiple transactions taking place. Proprietor is giving up all the assets. He is returning shares. Multiple transactions happening. Provision says every transaction will be exempt, provided whatever the assets this proprietor has, that are transferred to company only. In return, he should be getting shares of the company, nothing else. No money. He should be getting only shares. So proprietor giving up all the assets, returning receiving only the shares. He he shall become the only shareholder, and he whatever shares he is getting 100%, up to 5 years he shall hold minimum 50% of the shares, then this transfer would be exempt transfer. Then this transfer would be exempt transfer. Now listen to again second point. If a firm converts itself into company, provision says whatever the partners are, whatever the assets are, that shall go to company only. No asset should be sold to an outside. These partners should get nothing but the share capital. These partners should get nothing but share capital. Whatever the capital contribution is, in that ratio, they should get the share capital. Whatever the share capital that they are getting, all the partners, 100% share capital, they would be only getting. Provision says they should hold minimum 50% of the share capital up to 5 years. If they sell more than 50% now, then in that case, taxability would arise. Oh wow, sir. Oh wow. Provision says if all the conditions are fulfilled, then the subsequent, then this transfer will be exempt transfer. Sir, if any of the condition is violated, then newly formed company would be paying taxes. This company would be paying taxes. Subsequent entity that is being created will be paying taxes. Sir, sometimes what happens, sir, AOP is converted into stock exchange. Stock exchange. In that case, that would also be exempt transfer, provided whatever the transfer is, whatever the conversion is happening, that is because of SEBI guidelines. It is as per SEBI guidelines. If it is happening, it is exempt transfer. Now, what if a unlisted public company is converting into LLP? First of all, can an unlisted public company convert into LLP? Can every unlisted public company convert into LLP? Right answer is no. Not every company can convert. Only company with fulfilling two conditions can convert. See, in whatever year you want to convert, prior to this year, up to 3 years now, your turnover should not be more than 60 lakh rupees. Your turnover should be less than 60 lakh. That means if in current previous year you want to convert, then in preceding 3 previous years, your turnover should be less than 60 lakh rupees. In addition to that, in addition to that, sir, if you want to convert today, in preceding 3 financial years, in any of the year, your assets should not be more than 5 crore. Your assets should be 5 crore only. So two conditions you have to fulfill. Two conditions you have to fulfill. Then in that case, whatever the conversion is being happening, that is exempt. So, but some conditions extra to be taken now. Company is converting into LLP. Company is converting into LLP, so shareholders are getting nothing but profit share in return. Yeah, I should say PSR in return. Provision says whatever the asset this companies have, that shall be transferred to LLP. In return, the shareholder should not get any money. Rather, he should get profit sharing ratio. Perfect. Whatever their share capital is, in that ratio, they should get the profit share. Whatever the percentage of PSR that they have, they shall continue to hold at least 50% of such PSR up to 50%. 50% of the EPS are up to 5 years. What I'm saying is understand this carefully. Yeah? This is very important point. For example, company has 4 shareholders. These 4 shareholders become partners in a LLP. And it's each one of get 25% of the share profit. For example, new partner came, third partner came, fourth partner came, multiple partners came. But these 4 partners even today hold 60% of the profit. Provision says it is valid. These 4 partners should continue to hold 50% in the shares of the profit up to 5 years from the conversion date. To 5 years, then it is a valid transfer. And at last, sir, whenever a company is transferred, see, for example, it is company and it is converting into LLP. So company might have share capital of 1 crore. Company might have the reserves and surplus of, for example, 9 crore. Provision says whenever company is converted into LLP now, company is converted into LLP, remember, no reserve should be given to partner. Up to 3 years, no reserve should be given to partners. If it is given, then it is violation, and if it is violation, then tax has to be paid by the LLP. Tax has to be paid by LLP. Any of the violation take place, then successor has to pay the taxes. Got it, sir, got it. Now we have conversion of securities. If you have any bonds in a company, if you have any bonds in a company, if you have any debentures in a company, debenture stock in a company, and that have been converted into shares of the same company, it is absolutely exempt transfer. If you have preference shares in a company and that have been converted into equity shares of the same company, it is exempt transfer. If you have physical gold and you are converting them into the digital gold, then too it is an exempt transfer. Transaction with respect to non-resident are not to be studied; these are to be held. When we will study non-resident taxation, we will understand every point of it. in all the cases. Understand this thing. For example, this is Rahul and this is Rahul's sister. Provision says if I acquired a house for 10 lakh rupees in 2001, I did improvement in 2006 for 5 lakh rupees, and I gifted this house to my sister. She did improvement of 2 lakh rupees and sold this house in 2025 for 50 lakh rupees. Provision says what will be the cost of acquisition for my sister? Provision says whatever the cost of acquisition of the previous owner is, that shall be taken. That means whatever my cost of acquisition is, that shall be taken by the sister. So cost of acquisition will be taken of the previous owner. That's it. What will be the cost of improvement? Provision says if any cost of improvement is done by the initial owner, that shall be also taken. Old owner, that shall also be taken. Whatever the improvement that my sister is doing, that shall also be taken. Improvement done by the old person also, that shall also be taken. Period of holding. Sir, what will be the period of holding? See, from 2008 that shall be taken to 2025, or 2001 to 2025 that shall be taken. Sir, period of holding shall be taken of both the people. If it is an exempt transfer not leviable to tax, then period of holding of both the people should be taken. Mine also, my sister's also, because it was an exempt transfer. Last point, sir, from when indexation would be done, if at all required for tax purposes, if at all required, indexation would be done from the old owner only, and you have to cite a case law of Manjula J. Shah. Manjula J. Shah case law, you have to cite that indexation would be done from the previous owner only. Got this point? Got this point? See, cost of acquisition to be taken from prior owner. Improvement, current owner, prior owner, both. Period of holding, current year, old owner, both. And at last, sir, indexation has to be done. Indexation has to be done from old owner only. This is all about your exempt transfer, and this is all about your capital gain. Do not go anywhere. I just have to take you through the entire chapter and make you revise what we have studied till now. In a very fast track form, I am just going to lay down the basics as to how you have studied, how you have understood the entire chapter one by one. Just focus on next 5 minutes. Next 5 minutes, I'll make you understand the entire chapter. We started off with the basics where we understood the definition, where we understood the charging section. Any gain arising from the transfer of the capital asset shall be taxable under that capital gain in the year in which transfer took place. Then we came on to understanding the definition of the capital asset. We understood three things are capital assets. Any asset is a capital asset. FII holding securities, AIF is holding securities, and at last ULIPs. We understood these things. Then we came on to the transfer, any sale, exchange, relinquishment, compulsory acquisition, or conversion, or handing over the immovable property, or zero coupon bond. This was the transfer. Then we came on to rural agriculture land, whereby we understood what is urban land, municipal corporation, 2 kilometer area, 4 kilo, 6 kilometer area, 8 kilometer area. Then we came on to period of holding. Sir, for 4 assets we have to take 1 year of period of holding, and for other assets we have to take 2 year of period of holding. Held for more than 1 year, 2 year, then it shall be long term. Otherwise, it shall be short term. These were the basics we understood. Then we switched to calculation portion, where we understood full value of consideration minus transfer expenses will give us net consideration minus cost of acquisition minus improvement will give us capital gain. We understood the basics. Then in that process, we came on to point where we understood the sales consideration. How do we derive sales consideration? Normally, whatever the money we receive, that is sales consideration. But in case of immovable property, we have to see the SDV as well. If we are not satisfied with SDV, we would go to valuation officer. Sir, which money, which SDV to be taken, agreement date or SDV? Sir, the date on which we receive money via account paycheck. PC we understood. Then we came on to 50CA, which was about unlisted shares, 50D, which was about any other assets on which FMV is not determinable or sales price is not determinable. Then we came on to cost of acquisition. How do we derive cost of acquisition? Whatever price we pay, whatever the clear title charges we pay, whatever special cases. Sir, for example, we got asset free of cost, then previous owner cost we have to take. Intangible asset, if acquired free of cost, then zero. Acquired for some price, then price paid. Sweat equity shares, FMA we understood. We understood the different cases of cost of acquisition. Then we came on to advanced cases where we understood ULIP taxation, which is tax under capital gain, LIP taxation, tax under IFOS. We understood if ULIP's annual premium is more than 10%, then it would go to capital gain. But if it is less than 10%, it would be considered as capital gain only if annual premium is more than 2.5 lakh rupees. Then only ULIP would be taxed under capital gain. LIP, we did the same thing. If LIP is premium up to 10%, then if it is more than 10%, it would go to IFOS. If it is less than 10%, it would be only taxed if annual premium is more than 5 lakh rupees. Then we came on to slump sales, or how do we compute FMV1, FMV2, and cost of acquisition, that is the net worth. We understood that. Then we came on to the 45.4 and 9b, where we understood that if asset is being transferred by firm to partner at the time of dissolution or at the time of reconstitution, two sections are applied, 9b and 45.4. 9b talks about if this asset was sold to an outsider, then whatever capital gain would be applicable, whatever PGBP would apply, has to be paid by the firm. 45.4 talks about whatever the extra you are paying beyond the capital account of the partner is 45.4. Then we came on to liquidation, where two types of taxation take place. First is dividend, the other one is capital gain. Then we came on to, sir, we came on to 50AA, whereby capital asset would be long term, short term, we don't care, but capital gain will always be short term. It can be on market linked debentures, it can be on specified mutual funds, it can be on unlisted bonds and debentures. Then we came on to demat securities, where we understood that capital gain would be only applicable on the cost of acquisition would be taken as per FIFO method. Then we came on to advance money forfeiture, where we understood that if it is forfeited before 1st April 2014, then it is reduced from cost of acquisition. If it is forfeited later on, then it shall be taken to IFOS. Then we understood exemption, where 54 exemption, if we are any individual, if you are individual buying, selling residential house property, buying residential house property. 54b, selling urban agricultural land, buying urban agricultural land or rural agricultural land. 54d, if our industrial undertaking has been compulsory acquired, we are buying land or building for new industrial undertaking. 54ec, we are selling land or building which are long-term capital assets and buying bonds of NHI, RECL, PFCL, IRFCL, IREDA, HUDCO. 54f, we are selling any other long-term capital asset, buying immovable property, buying residential house property. 54gga, shifting rural from rural to urban, urban to rural, shifting from urban to SEZ. Then 1037A, which was about Amravati, and 1037 urban agriculture and compulsory acquisition. Then we came on to section 112A, which talks about listed equity shares, equity oriented mutual funds, and zero coupon bonds. Listed equity shares, equity oriented mutual fund, and business trust. If capital gain happens on these things, then it is taxed at 12.5% over 1.25 lakh. Then we came on to triple 1A. If on these three assets we have short-term capital gain, it is taxed at 20%. Then we came on to 112. Any long-term capital gain other than these shares is taxed at 12.5%. Then we came on to old provisions, that if any individual HF sells any immovable property acquired before 23rd July, then he gets a special benefit. Then we understood indexation, if any of the asset is transferred before 23rd July. For that matter, we had 4 different cases. If any destruction of capital asset take place, then transfer might be happening before 23rd July, then we have to do the indexation as well. But tax will be charged in the year in which money is received. Second case, if we convert our capital asset before 23rd July, then indexation would take place. Tax would be charged in the year in which we actually sell the property. Compulsory acquisition, if acquisition took place before 23rd July, then indexation would take place. After that, if money is received today, then in that case, whatever, then tax would be charged in current year. Of joint development agreement also, transfer would take place in the year in which asset is given to the developer, but tax would be charged in the year in which money is actually received. The completion certificate is issued. These were the old provisions we understood. Then we came on to miscellaneous provisions. Miscellaneous provision imply, sir, if we have income of 112A, triple 1A, or 112, do we get chapter 6 a benefit? Right answer is no. Do we get a rebate under section 87A? Under new regime, not at all. Under old regime, sir, we get rebate on all the incomes except triple 1A, 112A. Do we get any basic exemption limit benefit? Individual HUF resident one get on these 3 incomes, they get the basic exemption limit benefit. Then we came on to registered value, or then we came on to stock intended and capital asset. That was less relevant. At last, we came on to some provisos. Sir, if any non-resident invests into unlisted shares, then capital gain will be calculated in foreign currency. At last, we came on to exempt income, which was about if we transfer any of the asset, it shall be exempt transfer. Sir, for example, partition is happening in HUF, complete partition or partial partition. If we gift our asset to any person, sir, if we have parent subsidiary transferring any asset, if we have any amalgamation, if we have any demerger, sir, if we transfer any assets in reverse mortgage scheme, if we transfer in this stock lending scheme, if equity oriented mutual funds merge with other equity oriented mutual funds, or debt oriented merged with debt oriented, sir, in case of proprietor converts itself into company, partnership firm converts itself into company, or any company converts itself into LLP. At last, sir, we understood conversion of securities, and we understood how do we calculate cost of acquisition, improvement, period of holding, and indexation in all these exempt transfer cases. This is the entire topic that have been summarized. If you want to start off with this, you can start off with this. That will help a lot if you want to have a greater grip of the subject. That was all from my side today. I hope you really enjoyed understanding capital gain in entire English. If it was helpful, do like the video. Day after tomorrow, we will be studying PGBP in the same manner. Till that time, you have time to solve the question answers. Do solve the question answers of your own, and you will have a strongest grip over the subject. If you have any doubt now, you just message me out on Telegram. I'm always there for you. What all videos do you want? Do let me know in the comment section. We are planning to revise this entire TT in this live manner only, provided you support me. If you support me, you come live, you participate, then it would be a pleasure to come live. Otherwise, I will switch to recorded ones. It completely depends on you. So, thank you so much, guys. It was a great time studying with you all. See you guys in some other video.